Kishore, shall I start?
Sir, we can start, sir. It is streaming live on YouTube also right now.
Are you able to see all the panelists on the screen? Kishore, shall I start?
Sir, we can start, sir.
Good evening, all. Members, we are here assembled to have a very important meeting. Thanks to the postponement on this tax audit. Originally, when we fixed up on 28th of this month, people were surprised. How are you going to have a meeting on 28th when our last date is 30th? But as usual, we are very confident that there will be a postponement, and it has come true. We are able to discuss something today so that we'll be able to implement this in the next few months. And so that we'll be able to implement the job in a proper manner, because there are lots of amendments, there are lots of corrections, there are lots of modifications which are happening. So in this juncture, this meeting is going to be a very, very critical component. At CASC and EACA, we decided rather than having a lecture sort of meeting, we thought of having a panel discussion, because we'll have the wise counsel of few professionals who have been very seasoned. So we wanted to have a meeting. To make the meeting in a proper manner, I request Kishore ji, President of ACA, to welcome the group.
Thank you, Sundarajan, sir. Hello, everyone. A very happy evening to one and all. Namaste. I hope and wish that all of you are safe, in fine health, and are happier than earlier. It gives me immense pleasure in extending my warm welcome to all of you to today's joint webinar, wherein the Chartered Accountant Study Circle and Association Chartered Accountants, that is ACA Chennai, have joined together to bring you the most recent relevant topic for deliberation. A very special welcome to the speakers of the day, CA Anand P. sir, CA Ramesh sir, and CA Ramnath sir. Today's session is special due to the fact that even after 36 years of introduction of tax audit in India, we as chartered accountants face several issues even in filling of and filing of Form 3CA, 3CB, 3CD for whatsoever reason. We have listened to various speakers taking us through issues in tax audits, but we never had a panel discussion on this topic, at least in the recent past. So it was thought fit to get questions from the audience in advance, send them to honorable panelists, and get solutions. I hope and wish that all of you would be more wiser than earlier after listening to the esteemed speakers. I welcome you once again to this webinar, which I believe will be of good use to all of us. Over to you, sir.
Thank you, Kishore. See, we decided to have this meeting as a panel discussion. Immediately, we could decide on three of the eminent speakers, Mr. Ramnath from Coimbatore, Mr. P. Anand MR and Company, and Mr. S. Ramesh of SRBR Chennai. Basically, we have structured the program in such a manner that the questions are being split to all the three experts. One will be exclusively addressing on this legal issues, technical issues as far as the P&L items are concerned, and also the applicability, etc. The other panelists will be able to talk on this auditing and accounting standards issues. Another person will be able to dwell upon what are the documentation side of it, etc. Even though this is the overall plan, there is no compulsion for us to have the opportunity of hearing from all of them on the same topic, on the same subject. There's no problem at all. But we have structured in such a manner that the slides, we have made the questions also into the slide, which will be operated by Mr. Ramnath himself to go through each and every slide, and we'll be inviting all these panelists to have a presentation on those specific questions. After that, if time permits, if there are further questions will be coming on the chat or whatever it is, we'll be able to take it up. In the meantime, we will be going through this question. The speakers are so eminent and so familiar to all of us. I don't want to waste time in introducing all of them. Mr. Anand is a very, very seasoned chartered accountant with more than 5 decades of experience. And Mr. Ramnath, who is having more than 2 decades of experience on taxation. He has also written textbooks, etc. And Ramesh is also very, very seasoned in almost all the regional branches of the regional council he has been addressing. So I don't want to stand between you and them for having this deliberations to be kicked upon. We'll go straight away with Ramnath sir. You can share the screen. We can go ahead with these questions. So the first batch of questions will be on the basically the applicability of tax audit. The first few slides will be on this same similar line. I request Mr. Ramnath to take over and talk on those first few slides on the basically applicability of the tax audit. And depending upon that, we'll go for the next subsequent slides. Ramnath sir, you would like me to read the slide?
Not necessary, sir. I would handle it, not a problem. The organizers of both the associations, senior members of the profession, and senior colleagues in the panel, and fellow members, a warm good evening to one and all present here through this webinar. As rightly remarked in the opening remarks of this session, tax audit is one case where several years we have been continuously performing our attest function on this. Still it is so young. The chapter itself is so young to say that it keeps getting regenerated, and we have enough controversies thanks to the amendment, thanks to the rulings came from various judiciary, and also our genuine or ingenuine thoughts of the professionals and assessees. This is kept as busy, but still the onerous responsibility on the part of the professionals should be always taken note of when we are doing this attest function. Therefore, our association, institute, and other associations associated with institutes are educating our members. This is one good process whereby we have gained a chance to evaluate ourselves in terms of questions rather than going on a lecture mode. Very nice methodology of educating ourselves. So therefore, we now have picked up few questions coming from the audience and tabulated in the form. Any more questions subject to the availability of time we'll take up. First, we'll pick up a few questions dealing with the applicability of tax audit, whether the tax audit is applicable or otherwise. So the first query coming before us for our discussion is about the latest amendment came in the Finance Act 2020. Finance Act 2020 came up with an amendment in class A, below class A of section 44AB with a proviso. So the query relates to that. It says, as per the proviso below class A of section 44AB, the word 1 crore is substituted as 5 crore for the sake of the business cases. So that means if both the conditions of class A and class B of the proviso satisfied, that means there is no need to file the tax audit report. Assuming for a moment the turnover of the assessee is 3 crore and the assessee satisfied both the conditions regarding cash receipts and cash payment, whether the assessee can still file the tax audit report. If so, under which clause he can file that is the query before us. Now to appreciate it, we'll just have quickly the proviso below class A. So proviso below class A. Class A says every assessee every person carrying on business shall, it's a mandatory requirement, shall, if total sales turnover gross receipt as the case may be in business exceed 1 crore rupees in any previous year, shall get his accounts audited before the specified date, so on and so forth. Now proviso says in case of a person whose aggregate of all amounts received, including amount received for sales turnover gross receipt during the previous year in cash, does not exceed 5%, and aggregate of all payments, including amount incurred for expenditure in cash, does not exceed 5% of the state payment. This clause shall have the effect as if for the words 1 crore, 5 crore had been substituted. That means in case a person has satisfied both these conditions, for him, this clause of class A, the word 1 crore rupees shall be substituted by 5 crore. That means if a person has, having satisfied this condition, if a person has business gross receipt total sales turnover exceeding 5 crore, only shall be required to get the accounts audited. So Now class B, C, D, E, all of us we know it shall get his accounts of the previous year audited by an accountant before specified date and furnished by the date report of the audit in the prescribed form, so on and so forth. That means if the turnover exceeds the limit and other conditions of the proviso satisfied, he shall have to necessarily do it. That means a requirement that he has to necessarily do it. Now, if a person has satisfied these two conditions, but that means for him the turnover criteria will be 5 crore as against 1 crore. In that case, still if he is willing to perform an audit, under which class we can do audit? Effectively, none of the classes would apply. Class A would not apply. Class D and E also would not apply. So therefore, when we are filling up class 8 of form number 3CD, we will have to say under which class of the 44AB we are doing audit. We will not be able to say this. So mandatorily, when a person satisfies class A and class B of the proviso below class A of section 44AB, he would not be able to get the accounts audited under income tax law. Voluntarily, he can get his accounts audited by appointing an auditor, and the regular audit report as per SA 700 can be considered. But under income tax law, getting the accounts audited, furnishing form number 3CD, not possible, because in class 8 of form number 3CD, we will have to necessarily say under which class we are doing that. He can request the auditor to do an audit under general principle basis, but not in the as per the provisions of Income Tax Act. Now, further queries on the same line of thinking goes to say, if the turnover of an assessee is 1.5 crore, he does not want to take presumptive provision. That means he is not willing to go under 44AD subsection 1. Can he still file the tax audit report if both the conditions of the proviso below class A of 44AB satisfied? I think we have already answered. If he is not willing to go under 44AD, he should go under normal provision. If he is satisfied, up to 5 crore audit is not possible under income tax law. General principles he can go, but under income tax law not possible. The next query, if my turnover is 1.5 crore, all transactions by check, am I supposed to carry out audit though income is less than 6 or 8%? Now the term 6 or 8% is linking to section 44AD subsection 1. So 44AD subsection 1 says if you are an eligible assessee having eligible business and turnover up to 2 crore rupees, then if you are willing to offer that 8 or 6% subject to cash bank dealings, then no books are required to be maintained, etc. Now let us take a scenario of like this. A person has got 1.5 crore, all are by check. Now question is, if his income is less than 8 or 6%, merely because income is less than 8 or 6%, is he duty bound to get the accounts audited? Up to assessment year 17, up to assessment year 16-17, 44AD mandated an assessee who is having eligible business, an eligible assessee carrying on eligible business up to assessment year 16-17, that assessee is required to either offer the minimum threshold percentage as income or necessarily maintain the books of account, get the accounts audited. So 44AD failing which 44AB. That was the scenario up to assessment year 16-17, meaning either 44AD or 44AB as far as eligible assessee having eligible business. From assessment year 17-18, the law underwent a change. As a result, if the assessee was previously under 44AD and subsequent 5 years, a block of 5 years, any 1 year he walks out, year of walking out and next 5 years he cannot walk in, and in these 6 years audit is necessary if the total income exceeds basic limit. That means in the given case the assessee's turnover is 1.5 crore. For a moment let us not worry about transaction by check only, etc. 1.5 crore turnover, he unable to offer 8 or 6%, whether audit is necessary. So question will ask ourselves. In this case, previously whether the assessee was under 44AD or not, it's a question we have to ask to examine the applicability of 44AD for a case, because it is a case of subsection 4 of 44AD coming into picture. That means previously he should be under 44AD. This year he must walk out. Previous to this year, how many years in between crossed? From assessment year 17-18, when did he go inside 44AD, and whether that year plus 5 years he has completed? Definitely could not have been. In that case, year of walking out plus 5 more years necessarily he has to get the accounts audited. In this case, previously if he is not under 44AD, right, all along up to from assessment year 17-18 onwards is not under 44 AD. Now, this year 1.5, last year 0.75 crore, 0.8 crore, 0.9 crore, 0.95 crore, not under 44 AD at all. Now, this year turnover has gone to 1.5 crore. 8 or 6% or less than 8 or 6%. Turnover crossed 1.5 crore. Up to assessment year 19, turnover crossed 1 crore. Subsection 4 of 44 AD not applicable, audit warranted. Now, current year, assessment year 2021, one more thing we have to see. Previously not under 44 AD. Now, what's the turnover? Between 1 to 5 crore. Class A, Class B of first proviso, below Class A satisfied. Everything by check is what the query says. That being the case, up to 5 crore, audit not warranted. So, previously, if the assessee is not under 44 AD, subsection 1, then if all the transactions are by check, then necessarily there is no problem for him. He has to comfortably get out. With actual book results, he can go irrespective of the percentage. Now, previously was under 44 AD. Last year, assuming for a moment 1.25 crore turnover, he has opted for 44 AD. Current year, 1.5 crore turnover, income less than 8 or 6%, he is opting out. Even though all the transactions are by check, he is opting out. For him, 44 AD subsection 4 would apply. Subsection 5 would say necessarily he has to maintain books, get the accounts audited. In that case, 44 AB class E would apply, which will say a person to whom 44 AD subsection 4 applies. This proviso saying less than 5% cash transaction on payment on receipt, that proviso would not apply to that case of defaulting under 44 AD and walking out. There, previously, if the assessee is under 44 AD, this year he walks out, whether or not the transaction by check, since he is walking out, he would be required to get the accounts audited necessarily, because the percentage is less than 6 or 8%. The query here is the point to be seen here is whether in the previous occasion assessee was in 44 AD and walked out, or this is the year he walks out. If it is not so, and the fact goes to say everything by check, there is no need for getting the accounts audited. Otherwise, audit would be warranted. Now, the next query is, while calculating the cash component of the receipt and payment up to 5% limit for availing no tax audit case of up to 5 crore, what we have seen in the proviso, should capital contribution and drawing also be considered, or only transaction with outsider? The query talks about capital contribution or drawing. Now we'll have to examine to say whether the query is relating to a proprietor of an individual business, or query relates to partnership or AOP, as the case may be. All we have to examine. Now, the aggregate of all receipts, including receipts towards. Sundararajan sir, you would like to say something?
The point which I want to drive home is that cash transactions, is that very clear that as far as this cash transactions that is less than 5% is there, you are not liable for tax audit at all. Is it very clear and point blank? Because once it is beyond, that is up to 5%, this cash payment transactions are not there, I don't have an option to do tax audit at all. Is that right?
Yes.
So which means, if at all, which means I have to ensure that that is, each of us have to definitely verify the transactions to ensure whether it is limit is there or not. Because when they are going to, as an auditor, whether the transactions, I'm asking only on behalf of the members, because whether it is tax audit is applicable or not, we have to ascertain that first. Only after that, we have to do it. Is that right?
Absolutely, sir. Assuming for a moment, prior to this year, the turnover is 90 lakh. Necessarily, we would not have done audit.
Correct.
In that case, there is no option for us to say, even though my turnover is 90 lakh, go ahead and do audit.
No, correct.
44 AB. Similar is the scenario for the proviso.
Okay.
One may very technically go to argue that proviso gives me a benefit. I am voluntarily doing audit. Why are you preventing me? These are all something which one can create for the sake of hair splitting the provision. But if for a moment, let us forget proviso. If the turnover of the business is less than 1 crore, turnover of the profession is less than 50 lakh, for a moment, let us say 44 AD is not there, or IDA is not there, only 44 AB. Definitely, we would not have conducted audit under 44 AB.
But the query is not on that particular count. The query is basically because in the earlier occasions, the turnover is less than 1 crore. It is easily identifiable. But here, what happens is we are under an additional compulsion to go and verify whether any cash transactions are there or not. Otherwise, what will happen is, for example, in a particular case, less than everything is less than 5% only. In that situation, I am not eligible to be done under the tax audit at all. But without identifying that, I do the tax audit and report or whatever it is. Is there a violation on that point?
Naturally, sir. So it's a very first year, therefore we would be finding this way. Earlier also, if a person for 90 lakh doing audit, what would be the way? The same way would it would be appearing here. But we are now asked to do an additional exercise about the eligibility of tax audit.
That's what exactly I want you to address the members.
Yes.
They have
There
to
is
do
an
an
additional
additional.
requirement of verifying the eligibility of tax audit.
Okay. Please go ahead.
Fine. So now for the purpose of this receipt 5%, payment 5%, whether capital contribution or withdrawals could be considered. Now receipt per se, the word receipt or payment per se has to be understood as payment to someone received from somebody else. So if I make payment from my proprietor SP account to my personal SP account of a proprietor, or I am contributing capital in the form of cash from my personal account to a business account, there is no, technically there is no receipt. In the business books, we are introducing cash or we are introducing money through banking channel or withdrawal thereof, either in cash or on banking channel. But effectively to say, there is no receipt, there is no payment. It's only a book. We are introducing from personal book to business book or vice versa. So to that extent, if the case is of a sole proprietorship, for the purpose of ascertaining this 5%, the receipt from the proprietor, payment to the proprietor, either in check or in cash, both to be removed, and balance only we should consider as total receipt and cash receipt percentage, total payment, cash payment percentage. We will have to consider as far as proprietorship is concerned. But the same analogy, whether we would be in a position to take for the purpose of a partnership firm when partner contributes cash capital and capital through banking channel, or partner draws money in the form of cash or in the form of instruments, etc. I personally feel the same analogy extending to a partnership firm or AOP is slightly difficult, because under general law, one may argue that firm and partner one and the same, but in the income tax law, it is very difficult to take up that position, because law recognizes firm and partner as different. Therefore, money received by firm from the partner, money paid by firm to the partner would be regarded as only as payment to or receipt from. Therefore, this need to be factored for the purpose of discussion. This is for the purpose of this 5% limit, the payment by partner to the firm or by firm to the partner need to be aggregated. Whereas in case of sole proprietorship, this may not be warranted.
For a moment, Ramna, 216 SS or 216T, when the partners take loans and give loans, etc., we are considering that it is not applicable in respect of those partnership firms?
Now, if it is titled as a loan, then all the more the risk is there. If it is titled as a contribution, capital, personal account by other drawings account, etc., then there is no problem. But if we say partner's loan account and that transaction is via cash, then there could very good be a chance. Litigating possibilities are more.
Okay.
Any other supplementing, sir?
Anand sir, any
Anand sir and
Anand sir, any supplement? So you have to unmute and tell, sir.
Go ahead. No supplement.
Okay. Right.
Well, so the next is about. I would like to finish all the queries relating to.
First three questions you can answer. No problem. It's all allocated to you only. Please go ahead.
Then we will have the other aspects. The next is the interplay between 44AB and 44AD, and also few other interplays which we will have to see. Senior members would definitely recall that originally when 44AD came, it was on presumptive taxation relating to civil construction. Then we had this plying of goods carriages under 44AE. Later we had 44AF. That means at those times we had these three segments separately, and all other businesses are liable for audit and if the turnover crosses the limit. But when 44AD got recast, introducing or merging with 44AF, into 44 AD, not only civil construction, all other eligible business, then the concept of offering income under 44 AD for particular eligible business and keeping this turnover away from the total turnover for the purpose of deciding the tax audit, that concept is done away with when 44 AD and 44 AE merged. Prior to that, 44 AD, 44 AE, 44 AF, so long as the assessee is ready to offer the minimum threshold prescribed in the respective sections, that turnover shall be excluded from the total turnover, and the balance turnover of the any other business of the assessee crosses the threshold prescribed for 44 AB, audit would be warranted. For the purpose of turnover, these three businesses will be excluded so long as the assessee is ready to offer that minimum prescribed percentage or threshold prescribed. This is what the law. But after 44 AF and 44 AD got merged, now 44 AD talks about eligible business. So that being the case, if eligible business we are offering income, fine. If eligible business we are not offering income, we have to get the accounts audited. Offering income, one portion of the eligible business we are offering and segregating it from the other businesses and then saying that for that alone I will do audit. After the amendment in section 44 AD, being especially in a scenario after merging with 44 AF, this particular proposition, that enabling provision of excluding the turnover from the total turnover for the purpose of ascertaining 44 AB, that enabling provision is deleted in 44 AD, amended provision. That being the case, if there are two businesses, two line of activities carried out by an assessee, one he would like to classify as eligible business, go under 44 AD, offer 8 or 6%. Other one, he'll say, I will not come under eligible business, I'll separate it, I'll do audit and maintain books of account, get the accounts audited only for this second line of activity. Very difficult post amendment. Keeping that principle in mind, we'll just read this query. Can an assessee having two business declare one business under presumptive and another got audit done? Then turnover shown in the audit report will be only of the firm for which audit is done. After the amendment of 44 AD, the separation of one line of activity and coming under presumptive provision, balance all aggregating and coming under audit provision, not possible. Assessee wise, we have to aggregate. Exception contemplated would be 44 AE. In case where the assessee has businesses, many businesses, one of which is coming under 44 AE, then to the extent of that 44 AE activity, he is ready to offer the income as contemplated under 44 AE, that much turnover of that business he will exclude. All the balances we should aggregate as eligible, so long as it's eligible business, and they should either come under 44 AD, or if he is not willing to offer 8 or 6%, subject to previous year already under 44 AD, he should go under 44 AB. So splitting the business based on the activity, etc., post amendment, not possible. If a proprietary firm last year audit conducted being turnover 4 crore, this year turnover is 1.8 crore. Is audit under 44 AD mandatory, or should I conduct audit under 44 AB? So previous year, the query is only talking about previous year, 4 crore turnover in the preceding year. Let us say 19 March.
Right.
20 March turnover is 1.8 crore. 18 and 17, what happened? The query is silent. For a moment, let us presume 18, 17 also 2.5 crore, 3 crore for a moment. And this year there is a dip, 20 March dip. This assessee previously not under 44 AD. This is the year. Now we are examining. So merely because income reported is less than 6 or 8%, audit would not be attracted in this case. First. Now we'll have to now see 44 AD removed, 44 AB class E removed for our discussion. Now we'll have to examine the applicability under 44 AB class A, read with proviso. Now go to class A, turnover exceeds 1 crore, audit warranted, subject to proviso. Now proviso let us examine. In this case, up to 1.8 crore turnover, receipt and payment we prepare, more than 5% cash transaction has taken place. Above 1 crore, therefore audit under 44 AB class A warranted. 44 AD is not mandatory in this case. 8 or 6% is not required to be minimum offered. Merely because 8 or 6% is not offered, one would not be requiring the accounts to get audited here. But we'll have to say test whether audit is warranted under class A or audit not warranted under the proviso to class A. If proviso's conditions not satisfied, audit would be warranted. Proviso's condition satisfied without doing audit, without coming under 44 AD, whatever be the book results, 3%, 2.5%, that book results can be declared without doing audit. Whether the SSE will lose the benefit of 44 AD if he has done cash transaction in excess of the limit prescribed for the receipts and payment. Next is also similar, we'll take it together. Even for tax audit cases, there is a requirement to report cash receipts and payment. If he has exceeded the limit, will he lose the benefit of offering lesser percentage? Now, both these queries are somewhere interlinked to 44 AD class 44 AD vis-a-vis 44 AB. Now, let us first make one thing very clear. 44 AB, 44 AD, we will keep it separate. Previous year, the assessee must have already availed the benefit of 44 AD. And now he walks out. In the year of walking out, on the reason that turnover is less than 2 crore, unable to offer 8 or 6%, then audit would be warranted. In that case, even if the turnover is falling between 1 to 5 crore, he has walked out of 44 AD, he is in that lock-in period of year of walking out plus 5 years. In that case, even if his turnover is falling between 1 to 5 crore, all the transactions are only through banking channel. Nevertheless, he cannot escape the audit because he is coming under 44 AB class E. The proviso is placed below class A of section 44 AB. The benefit of 1 to 5 crore no audit, that benefit is extended only for 44 AB class A cases. That benefit is not extended to 44 AB class E cases. If a person has already gone into 44 AD, walked out, year of walking out plus 5 years, lock-in period of 6 years, even turnover is falling between 1 to 5 crore, all the transaction by check, still audit cannot be avoided. He has to necessarily get the accounts audited. So in case if the turnover is between 1 to 5 crore, 5% or more happens to be cash transaction, then for him audit under 44 A, B class A would be applicable. Therefore, if an assessee is having turnover of 1 to 2 crore previously under 44 AD, this year also is ready to offer 8 or 6%, coming under 44 AD, this 5% etc. would not apply to him. If you would like to take that 6 or 8% regime, he can continue, no problem at all. Now, in a case where an individual assessee opt out of 44 AD, tax audit is applicable for that year and plus 5 more assessment year, provided from 17 within 5 years period he walks out. 17 he opts in, 18, 19, 20, 21, 22, all the years he is in. 23 he walks out, this restriction is not there. 1 year he can walk in, 1 year he can walk out, no problem at all. Now, during these 5 assessment year, if the total income is less than basic limit, there is no requirement of audit because subsection 5 of section 44 AD, 44 AB clause E both say you are violating this condition of 44 AD, you are walking out that year plus 5 year, you need to get the accounts audited provided
The turnover.
only if your income exceeds basic limit. You are walking out, but in the year of walking out, your income is less than basic limit, audit is not warranted. Next 5 years, you are walking out and thereafter next 5 years, income falls below basic limit, no audit is warranted. Now, in the case of now year of walking out, 5 more years, assuming for a moment all these 6 years, there is only income less than basic limit. Thereafter, whether audit required to be extended for additional years is the query before us. Whether that 5 years to be counted on an year where you do not have income or you have income excess of basic limit. Suppose in between some years income is falling below, whether we have to remove that and still identify 5 years not completed. The law doesn't say so. Year of working out plus 5 years, you have to get the accounts audited provided the income exceeds basic limit. The income does not exceed basic limit, that 5 years lock-in period is over. Thereafter, there is no problem. That is how the law appears it to be. So therefore, as because in the interregnum period, the turnover for the basic limit income is not reached, for that reason, the condition of audit will not get extended. Because this is what the text of 44 AD subsection 4 and subsection 5. This clearly says not in accordance with the provisions of subsection 1 in any of the 5 years, then the year of working on the next 5 years, he will not come under 44 AD subsection 4. For that period only, subsection 5 would apply, provided the income exceeds maximum amount not chargeable to tax. Otherwise, it would not be applicable. Now, this is a scenario where a trust, whether audit would be warranted. Now, trust section 12A, subsection 1, clause B says if their income exceeds basic limit before claiming the benefit of 11 and 12, audit would be warranted under that section, not under tax audit provision, under that section. But subsection 4 and subsection 4A of section 11 contemplates that property held under trust can include business also. Supposing there is a trust, somebody else donates a business to the trust and separate books are maintained for that business. Now, in that case, for that business, tax audit provisions would apply if the turnover crosses the threshold, etc. But trust activity is purely charitable. For them, provisions of 44AB would not apply, but provisions of section 12A subsection 1 clause B would apply. In that case, turnover criteria, gross receipt criteria would not apply. If the income before claiming 11 and 12 exceeds basic limit, audit would be warranted. But if the trust has within the trust itself a business held under trust for the purpose of achieving its object, then to that extent for that business activity separately, normal provision what we have seen for other provisions, other cases would also apply. A firm is engaged in management consultancy service, will it come under 44 ADA or 44 AD? To appreciate this, we need to see what is that 44 ADA talking about. The 11 professionals contemplated under subsection 1 of 44 AA can come under 44 ADA. And in that case, if the gross receipt does not exceed 50 lakh and they are willing to offer 50%, they will come under that. Otherwise, audit would be warranted under 44 AB class D. Now, the income tax department has given code for each business activity. If you carefully see the code itself says this will be considered as profession coming under 44 ADA, which you will not be able to bring under 44 AD or vice versa. If you carefully see that code, we will be able to see that business and management consultancy services 16013 code given under professional category subsector business and management consultancy service. The income tax department schema says it will not be eligible to come under 44 AD. It is eligible to come under 44 ADA only. So therefore, this SSC rendering management consultancy services will be considered to be doing profession as contemplated under 44 AD, 44 AA subsection 1, and consequently, so long as the gross receipt does not exceed 50 lakh, he will come under 44 ADA. And if he is unable to offer 50% as his income, he has to get the accounts audited. If the gross receipt exceeds 50 lakh, he will come under audit provision under 44 AB class B. But 44 AD not possible for SSC, going by the code prescribed by the schema of the income tax department.
Mr. Ramnath?
Yes, sir.
See, what happens is, just because of a schema correction, can the intention of the statute be amended? The reason why I'm asking this question is, whenever a person is doing a management consultancy activity, it will be coming under 184J as per this TDS, etc. All these things are okay. But at the same time, take the case of an what you call an HR consultant. For a time being, I will just take an HR consultant. He does two activities. One is he's doing HR consulting, another is doing placement services. So for one session in the normal course, he might be eligible for 44 AD or not ADR as the case may be. Just because you have modified the schema, I'm just asking a question in such a manner that just because I'm modifying a schema, can the intention of the statute be modified?
Now, in the given example, he is doing two different services. One will fall under management consultancy service, other will not fall under management consultancy service.
Okay.
To the extent to which it falls under management consultancy service, he will come under 44 ADA.
Okay.
To the extent to which it does not fall under management consultancy services, he will go under 44 AD. Nothing prohibits.
Nothing prohibits.
Schema does not say moment you choose 44 ADA, you are prohibited from choosing 44 AD for any other line of your activity.
Correct.
The law, the income tax form permits an SSC to have 44 AD, 44 ADA, 44 AE, still any other business. Fourth one coming under audit or with the book results, all are permissible. And I can even go to the extent of saying 144 AD, 144 ADA, 144 AE, plus one business income coming under book results, one without maintaining books, a commission estimated, all schema permits. Schema does not say moment you choose 44 ADA for one your line of activity, you are prohibited from offering all other things under respective domains. That is permitted. That is not prohibited. But for this line of activity, when there is a controversy, management consultancy service, whether it is eligible to come under 44 AD or it should only come under 44 ADA, for which our understanding is to go under this particular provision. The assessee engages himself to do something else additionally, and that qualifies for the other provisions of law. Nothing prohibits. That can be always possible.
Can I supplement here one?
Please, sir. Please.
Go, sir.
See, normally profession is supposed to be done by individuals or a group of individuals. So the management consultant services done by a corporate entity or a firm or something like that, where it has more than individuals as partners, will that come under the same category? Can you come under 44 ADA and all that? Because it won't be, in my opinion, a profession. It's a business.
Fine, sir. Effectively, when section 40, that this is a very interesting proposition. The section 44 AD talks about eligible assessee carrying on eligible business. Now the explanation below section 44 AD says eligible assessee means an individual, HUF, partnership firm other than LLP, all being resident. Now when we go to 44 ADA, the section says resident assessee. But in the memorandum explaining the finance bill introducing 44 ADA, the language says individual, HUF, partnership other than LLP. And the schema also, when we choose 44 ADA, if the status of the assessee happens to be resident, residential status happens to be resident, and status happens to be individual, HUF, partnership other than LLP, it permits. Supposing we have a limited company carrying on this or an LLP carrying on this, those sections is resident assessee. It does not prohibit anything else, but the schema restricts, going by the memorandum explaining the finance bill, saying that it is only for an individual, HUF, or partnership firm other than LLP. So to that extent it is taken care of, but still when the section itself is made explicit, this controversy could be avoided. But as of today, while filing the return, it gets restricted, but the section does not explicitly prohibit. But if the section itself is amended, all the more it is going to be comfortable.
But firms can do a profession, no, sir. Honestly, firms can have
firm. If the professionals come together and make a firm, they can carry on the profession. That's what our charter
they will be eligible for 44 ADA. Then they will be eligible for 44.
Firm can also sometimes have limited companies as partners and all that, in which case it cannot carry on the profession, because profession is supposed to be done only by individuals giving advice based on an individual basis.
Fine, sir. Sir Ramesh, sir, you would like to add something?
Ramesh, sir?
No, I think I agree with Mr. Anand regarding the firm, the classification of the firm. Unless all the members of the firm are professionals in that particular field of profession, then only then will it be a professional firm. Even if one or two of them are not the same profession, I don't think it can be classified as a professional firm. It can only be classified as a business firm.
But for a moment, we can think about an MDP practice which is going to come. It has been in the offing. So what happens?
But even MDP practice, it is only among individuals. There is no.
No. That's what exactly between what you are suggesting and what Ramesh is saying. You are talking about between individuals, but Ramesh is telling different professionals cannot come together, which is not possible. In case of an MDP, a chartered accountant, a lawyer, and a valuer can become
all professions are permitted. In that, profession is one-to-one.
Because they are different professions, but they are. It is permitted.
Forming together as a profession.
Yes, it will be permitted by law, and therefore it will still be a professional firm.
That's right. Ramnathji, go ahead.
There's another one interesting query. Simple with reference to interpretation, this query, because the language is used in the law is attempted to be understood in a manner in this query. Specified date is 1 month prior to the date of furnishing of return of income under 44AB explanation. Now, this Finance Act 2020 advanced or rather separated the date of furnishing the return and date of furnishing the report, leaving 1 month in between. So, the queryist would like to say the due date of furnishing return as per the revised extended time is 31st January. 1 month to the due date is 31st December. Date 1 month prior to the due date 30th December, And our section 44 EAB says audit should be done before the specified date, not on or before. Therefore, we'll add one more day. So that means whether do we need to take 29th as the last date or 30th for our signing is the query of the queryist. Now, the word prior should not be presumed to be 1 day prior. The prior is the, we are communicating the direction. 1 month. 1 month date of filing of return is this. 1 month time we have to count. In which direction we would like to count, whether prior or succeeding. So to give the direction, the word prior comes here. So that means this is the date of filing return. Go backwards, take a month. That means exactly 1 month, 1 calendar month, British calendar month. That is the case. 31st of December would be 1 month prior to the date. It is not 1 month is 31st and prior to that is 30th. So to give the direction, which direction we would like to go from the due date, that prior is the language used in the law. So therefore, if 31st January is the date of furnishing return or due date of furnishing return, then 1 month prior to 31st January will be 31st December. And as rightly mentioned in the query, our date of signing of tax audit report should be at least 1 day prior to the specified date, because language used in 44 AB is the assessee shall get the accounts audited before the specified date and furnish it on or before the specified date to the department. So therefore, ideal to date it up 30th of December, the word prior to be accordingly interpreted.
There was one question which has come, but it has not been part of this group. Just for the sake of interest, I am just raising this point.
Yes.
One chartered accountant came and asked me whether this 1 month is compulsory. That is, even if I am ready for an audit on particular date, should I wait for 1 month for filing the return?
So this requires the history to be explained. The idea of separating 1 month, whatever purpose for which it has come up, has not seen the light of the day for this year. The idea was the financials today in the tax audit report, we are 3CA or 3CB. What we say, let us say 3CB. The first point we say, we have audited the attached profit and loss account and balance sheet. It is original form. Along with the report, we used to attach physically the financials. But today in the electronic era, in the 3CB, 3CD, we are attaching PDF. But in that PDF, whether financials are there, part of the financials are there, department is finding difficult to reconcile. So now the plan is, whatever manufacturing, trading, profit and loss account, balance sheet available in the return is planned to be taken out of the ITR, made as part and parcel of 3CD, so that we will fill up the information relating to financial in XML form. And then we will say in 3CB or 3CA, as the case may be, to say we have audited the attached profit and loss account and balance sheet. And then we will upload. So that the return will have this information as pre-filled, automated. Government wanted time to do this exercise, automate it and make the return uneditable to this extent. And thereafter, information additionally required to be obtained from assessee for the purpose of processing the return will be exceptionally asked independently. For that, government wanted a time. That's the reason why the time limit between furnishing of audit report and furnishing of return of income got separated. Because of COVID, these forms could not be altered, the schema could not be made ready. Therefore, this year, the old concept would continue. So we will be filing the tax audit report with PDF attached financials, and then return will continue to have the XML version of manufacturing, trading, profit and loss account and balance sheet. And therefore, we are voluntarily filing both. In that case, today, if I file 3CD, assuming for a moment schema all functionality goes well, the same day after approval by the assessee, if the assessee login, if return is getting processed today and filed, there is nothing wrong in it. But the idea here is to see that this is getting shifted, but in this year it has not happened. Therefore, mandatorily gap of 1 month is not warranted today. But in the next year, I personally feel after filing, the system would not permit filing return for a couple of days. Till such time, the return gets auto-populated and thereafter only things would come, or else independently assessee can file without this information. The other information may get auto-populated. That's the idea behind making this amendment, but this year this is not coming up. Therefore, the old methodology what we have been following will continue to follow.
Okay. In fact, this was one of the questions raised by one of our friends, which I wanted to ask in the last stage. You have already answered. What was the intention before between this 1 month? You have already answered it. Thank you very much.
Thanks, sir.
Proceed with the plan.
The next,
Ramnath sir,
yes, sir. Please.
just to carry on with what you said, that the direction was shown in by defining prior to 1 month. Supposing, let's assume that this year, instead of 31st January, they extend the date to 28th of February 2021. Now, do I have to submit my audit report before 31st of January, or will it be 28th of January or 29th of January? Do I have to actually calculate the 30 days exactly, or can I take it to the last day of the previous month?
He was referring as British calendar month. So in that situation,
was.
to go with
He was. I caught that. He said British calendar month. When you take the Companies Act, they have said 30 days.
Correct.
Here they have not said anything like that. They have only said date 1 month prior to the due date. So can I not interpret it as the last day of the previous month? Is that possible is what I want.
Fine. That means 1 month prior to that, assuming for a moment 25th of January is what is considered as the due date given by the department because of extension. Now, if you take a month, effectively to say that 1 month means 25th of the December, but I'll still argue that the calendar month of a British calendar month concludes on 31st December. Therefore, I'll take up to 31st December, so that if the department puts a day other than the end of the month, department will be at a loss. To that extent, the broken period is what Ramesh sir would like to convey.
Is that possible? Of course, this year, in the press release, they have very clearly stated, consequently, the date of furnishing of various audit reports under the Act has also been extended to 31st December 2020. So they have
given the date. They have given the date this year.
We're talking about if this had not been specified, and they just said that the return has been extended to, let us say, as you rightly said, no, instead of 31st January, they said 20th of January.
Possible, sir. It is always possible, sir. This is hair splitting, definitely possible. And we have number of judgments in the context of 54 EC, just for discussion, that says 6 months from the date of the transfer. One tribunal judgment went on to say the 6 months from the date could be read as 6 months. He must have complete months after the end of the month in which the sale took place. So that means count end of the calendar month and then 6 calendar month you give. That means effectively 25th of October, if a person made a sale of immovable property, 25th to 31st let us finish. Thereafter 6 more months we will give. So only end of that calendar month he is entitled to make investment under 54 EC. That even by date, if you see 5-6 days later he might have made, but still he is entitled to. We have got one case law, but all said and done, how do we define a month? That's a case which we will have to see. And now income tax law does not define the month, and we have to go to General Clauses Act. That is British calendar month, and that is where, of course, old judgment is there to say that you have to count it 1 day. You should take this day and go back to the corresponding previous British calendar month. And if you want to count 1 month, take today and take one full succeeding calendar month of the same day, 1 day prior to that. This is what is considered as 1 month, is what one judgment goes to say. Therefore, it is still open for interpretation on either side. Assessee would like to take the advantage. The better wisdom must prevail to say the due date is always given only at the end of the month rather than giving at piecemeal, so that these sort of things could be avoided. But definitely this is not free from controversy. One can always make out saying British calendar month, 1 full month has to be given. We will be very vehemently arguing like this, and the department would also be like to argue on the same line when they have started calculating interest on TDS. They'll say we'll take calendar month as separate. 25th, 7th of April is the due date, 8th of April the assessee makes payment, and the due date, suppose the date of deductibility is 25th of March. 25th of March to 31st of March, 1 calendar month. 31st of March to 8th of April, another calendar month. We'll put 2 months interest, we'll say. So one side, when we are trying to extend this provision for our benefit, equally it is sought to be done at the side of the revenue as well. So therefore, these are all the scenarios when manually we were calculating interest. This was really making huge question of time, etc. Today, at least the law could be amended, reframing Rule 119A to say interest shall be calculated on a simple interest basis from the date to the date, simple, without considering month, etc. Today, everything is done by computer. At least these sort of controversies could be avoided. But unfortunately, this is not done. Either side, it cuts, not only for assessee favor, in other provisions, the British calendar month puts the assessee also in trouble. And considering smallness of the numbers, we are unable to find it so interesting to challenge it in appeal, etc. When 201 order comes, levying the interest, 201 interest, 201 order comes, we are not finding it so encouraging to go and file an appeal considering smallness. We ask the assessee to pay. This is what the problem on either side, which we have to necessarily reconcile.
Okay, go forward.
Fine. Next is very interesting query on, again, interpretation. The language of section 44AB says the applicability would be on when total sales, turnover or gross receipt is what three phrase mentioned: total sales, turnover, gross receipt. As the case may be. What is the meaning of the term as the case may be is what the queryist would like us to handle. Now, what is the inference one should draw because of the language? Supposing turnover alone we take, that is something. Gross receipt alone we take separately in a business, that is something. And sales we take separately, that is something. Sales for goods, services related, gross receipt, turnover something other than like for conversion of capital asset into stock in trade or stock in trade into capital asset, all other aspects we take. Whether assessee can say this is less, this is less, this is less, I will not aggregate, or where is that it says that we will have to aggregate, is what the queryist would like us to understand, address, and what is that, whether aggregation principle would apply, or if so, whether it is dependent on the method of accounting followed by us, is what the three query just come up because of the one important phrase available in the particular section, as the case may be. Time immemorial, we have been doing it, but it's really food for thought for all of us to see. Now, as the case may be, does by itself go to say we are having a choice, we'll pick up the respective things or otherwise. In my personal opinion, one assessee may have any one of this, may have more than one, may have all the three, depending on the nature of activity carried out by assessee. If sales, turnover or gross receipt, either one, whatever comes, aggregate everything. The underlying principle is that total is there. Total need not be restricted only to sales, turnover, gross receipt, all that should be total. And wherever, depending on its applicability, some assessee may have only sales, some assessee may have turnover, some assessee have gross receipt, that need to be aggregated, and that crosses the threshold prescribed, we will have to do this. And the question that if we go by that analogy, aggregation need to be made. Whether this is going to be dependent on the method of accounting or the basis of accounting chosen by SEC. I think the underlying principle here is with reference to the tax just duty by whatever name we call it. If the SEC follows net method, what would happen? If the SEC follows gross method, what would happen? Is what I believe the last part of the query seeks to address. Now, I personally feel if the SEC in the books of account regularly maintained follows the practice of recognizing the tax collections and tax remittances of P&L items as balance sheet items, it should not form part of the turnover. It should not form part of gross receipt, as the case may be. It is not dependent on how you record it, but based on the entries made in the books, it should be counted. But that by itself would not go to say these collections, remittances appearing on the balance sheet side by itself, since it is not routed through profit and loss account, that non-payment of these things up to the due date of furnishing return of income would not warrant 43B disallowance. That argument is not acceptable, because in Saurangi Sales Bureau Private Limited case, Honorable Supreme Court said the collections toward VAT is part of trading receipt. You may show in the balance sheet as a payable item, but it is considered as trading receipt. You will have to count it for 43B. But in the books of account, if the SEC follows net method, then for the purpose of this turnover, this collections towards the levy, etc., need not be aggregated.
Here, can I supplement?
Please, sir, please.
Section 145A, the accounting standard which came in, they wanted the tax which is taken out to be added on to the purchases, opening stock, closing stock, turnover, and all that. Which means that the accounting method that you follow is not what the accounting method the department wants. So in which case, the thing could exceed the 1 crore limit. If you have removed the sales tax collected or GST collected But now by adding and showing the turnover, you will definitely get into that. So better is not to take a risk and do the audit. And as far as this gross receipts is concerned, anything that is shown in the business books as a receipt, according to me, should be form part of it. It's not, though it is related with the turnover. That's why the institute guidelines note also says turnover and then gross receipt. So you should have some relationship to the turnover. But I will still feel gross receipt. For example, if a person has a manufacturing business but also has an investment on which dividend is coming in, that is also a receipt from the company, which is a part of the income. So I will say it should be treated as part of the income, and on that basis, the turnover, the what you call fixing the criteria for the tax audit should be taken into account.
Sir, when you call it as a dividend, etc., don't you think that it is not part of the business turnover at all? It's normally we
It's part of the gross receipt, not part of the business turnover. It's part of the gross receipt.
Okay.
Sundarajan sir, Anand sir's point is it is investment.
Okay.
From investment dividend is coming, why not we consider as gross receipt?
Okay.
Then I think I would now give a break and we will take up.
Okay, then we'll go for the next question.
2-3 slides. I'll break it, sir, because
okay, this we can go.
This is with reference to.
This is with reference to asset. The question is I'm posing to Mr. Anand. Assessee have an MIDC plot as a leasehold and constructed their factory and claim depreciation over a period of time. The WDV is 1 rupee only, that he transfers the land at 1 rupee only. Although the stamp duty for the purpose of valuation is 1 crore under section 50C is not, but section 50C is not applicable to leasehold land. Then WDV shown in the last balance sheet, should this be debited to capital account straight away, or is there any other option?
See, first of all, lease transaction, how do we account for? The guidance note or on the how to have the asset done. The lease premium that we pay is part of the capital asset, and it should be written off over the period of lease. And in some of these industrial development things, they give a 99 years lease, and we treat that as part of the land, because normally 100 years the Transfer of Property Act says the property moves on to the other person. That's why they put 99 years. But 99 years we take it because it's such a longer period that it more or less considered as a part of the asset. That's how the accounting is being done. But there is an interesting Karnataka High Court decision which says that since it's a 99-year lease and the asset is not yours, it's a revenue expenditure. They don't even consider it as a capital expenditure. They allowed it as a revenue expenditure. Barring this, you still come back to saying you are treated as a capital asset because you are claiming depreciation on the building. So leasehold land should have been there. Because that's even the fixed asset accounting standard, how to depreciate a leasehold land is given. So you have to treat it as a capital asset. And the definition under 50C talks about a capital asset. There is no way an exemption shown that a leased land is exempt. You see the 50C and read with section 214. It talks about immovable property. It doesn't talk about a leased land and being out of 50C. So my feeling is that this proposition that 50C will not be applicable is not acceptable to me. It will still be applicable. So if you are seating it as rupee 1, that means if the lease period should be over. Otherwise, rupee 1 is not going to be there and you are selling it. Then definitely 50C will be applicable. Assuming the accounting entry to be made, you are transferred, 50C you are seeing it separately for assessment purposes. The entry will be like you will have to debit the balance only to the capital, either through, because if it is treated as an asset and you are realizing 1 rupee for the sale, you will still be arriving at a profit or loss, because you will have to close the asset, bring it to the profit loss account, and it will automatically transfer to the capital account balance. If it's a partner or proprietor, capital account, otherwise to the reserves and surplus in the case of a company. That's how it will happen.
Ramesh, anything to be supplemented? Because being an accounting issue, is there anything to supplement from your side?
No. I think that's precisely what I also thought of as the answer.
Oh, fair enough. We'll move on to the next question. Sir, next question, Ramnath, because you are having the control on the slides. This is also to Anand sir, how to calculate depreciation of assessee who is declaring income under presumptive provision for last 4 years? We'll go one by one, or we'll read out all the questions.
I'll take it back. one by one. See, the presumptive taxation itself says that all the expenditures is supposed to be allowed, and on that basis only calculated. So the depreciation is also supposed to be allowed. So you should have calculated depreciation on a year-to-year basis and accordingly reduce the value of the asset. So after the end of the 4 years, if you want to come out of the presumptive position, the return on value after the end of the 4th year alone, you can take. I think we have also case laws in this regard. So that is how we should follow. So how does one allocate the unabsorbed depreciation to various blocks? Not able to exactly understand what do you mean by unabsorbed depreciation. Maybe presuming that they have depreciation and a loss and that they have unabsorbed depreciation, automatically the depreciation is calculated based on the blocks. So there is no question of allocating it on some crucial way, except at a slump sale where it's a total price and you have individual assets, you can go by some value of the assets and transfer. That is how the courts have also interpreted. So I think there should not be a problem on that. How is the amount of fixed asset treated for disclosure? I assume that it is a asset scrapped or something like that.
Written off is missed out. Written off.
Written off, treated for disclosure. Income tax doesn't recognize this kind of write-offs. Either it says a sale value to be credited in the block, or it should be still in the palm of the asset. So if you are writing down the value as far as income tax is concerned, you can, if you bring it to the value to a zero, they still not accept because they are not scrapping it and allowing it, taking it as a scrap sale. So ideally, if you want to get something allowed, put some scrap value and say it is a scrap value that is sold. Even deduct TCS on that and done away with that. Otherwise, the value that is there in the books for depreciation as far as income tax will be there. But as far as the company law things are concerned, the standard quite clearly says that asset which is for disposal should be shown separately at a return on value and all that. So that the accounting standard will take care of.
For a moment, you can look at a case where only asset is a building, sir. Or for the case, we can take it as only asset being machinery, which is lost in fire. So understand it is lost in fire. So actually, it is fully, it has to be written off only. You don't have any other option. So in that situation, how do you deal it in the income tax?
So if it is written off, then you say the value because no value can be realized. It's a zero that is realized, and then reduce the total.
So what will happen? The only asset which is going to be there in my balance sheet.
No, that's what.
It won't even be an asset any longer, Sundar, because
so which means in the income in our
so
how do you see it in the 3CD? How do you that is the intention? How do you
3CD? You will have to say that disposal is zero. The value is disposal and reduce the take the minus to the profit loss because under the short-term capital loss, you will have to take it to the profit loss account and then close it. The income tax officer still may come back. You will still have some scrap that you will have to argue it out and get it.
Okay. Once again, next is also for Anand sir. Several parts of Form 3CD require the auditor to report on personal transactions of the SSC which are not connected to the business or profession. Example, they have given the clause number 17, where it is relating to 50 say item, which fall under other sources. Where is the question?
Last.
No, I will answer this.
Can I say correct? Question is there in A. Can I say CA still rely on the above case law? There is a case law also is referred. Please go ahead, sir. You have started already.
See, the tax audit report is entirely about the balance sheet profit and loss account which you are certifying and taken out of that the details. So if some of these details are not forming part of that profit and loss account, there is no way that you can report on them because you are not auditing them. So my opinion is that you need, if it is not part of the books of account, we need not do the reporting this consent, whether you go through the case law or not, because this only a supporting when somebody officer takes it saying you should have done, you can quote it. But according to me, we are very clear that it is not part of the profit and loss account which you are auditing. You need not answer the 3CD details.
But normally what happens in this sort of things, there I'm just
even in the case of a proprietor, I would say that still you don't have to answer because you are auditing only the books of account. You are not computing the income where all these things will come.
And I think the guidance note on tax audit by issue by the ICA also takes the same view. That you don't have to report on anything other than the financial statement figures flowing from the financial statement that you're auditing. So if these personal things are whatever they're talking about are forming part of the financials, then you got to report it. Otherwise, you don't report it.
See, what happens is, if he is only having one account, for example, an individual proprietor is there who is having only one current account, and unfortunately, the one particular sale of transaction also, sale of property also comes through that account only. When you do the accounting, it would have been credited to that particular. I mean, when the bank is debited, his personal capital account would have been credited to that extent. Do you mean to say that it is forming part of the financial statements or not?
See, it is a kind of a capital brought in by him, and you don't do any reporting on the capital that is brought in by him in the tax audit report. So whatever it is there, part of the profit and loss account alone, in my opinion, should find a place.
Part of the profit and loss account, not being part of the books of accounts, part of the profit and loss account. Exactly, I wanted to
see, the main is that they want you to audit and give them on a platter the expenditure which is to be allowed and all that. That's how if you run through the thing, they're saying personal expenditure, amount paid to clubs and all that they are saying. So it is literally the expenditure is what they are concentrating, and it's on the books of account. So I don't think this you will have to report, even if you credit it to the capital.
Clause number 17, if sale value is less than 5% of the stamp, no adjustment. Anyway, that also question is also answered by the...
Doing the other one, then this comes in, this doesn't have any relevance now.
So that it is the question is slightly on a different note. Clause 17, if the sale value is 5% less than the stamp duty value, no adjustment required under 50C. But the disclosure under clause 17 does not provide for exception. It only says what is the SDV, what is the transaction value.
Yeah.
That both we have to report. Even if it is less than 5%, auditor cannot avoid reporting.
Yes. That I agree.
That is what the clause says, is what the queryist would like to bring us to us with. Yes, because it is less than 5%, we cannot say we will not report. The reporting is mandatory, because that time when report clauses introduced, 100 rupees difference also required to be reported. When 5% ceiling came, correspondingly amendment did not come in 3CD, less than 5% cases don't report. That has not been incorporated.
Yes.
So that still continues, is something which we will have to...
Once again, if this asset is non-forming part of the accounts which you are auditing, you don't have to mention?
Yes, naturally.
Actually. So one slight differentiation or deviation from the tax audit issues, in the code of ethics, this sort of issues comes. That is, wherever you are dependent, even though you are saying that we don't, whether this decision is there or not, we don't have to report on all those issues, etc. That's for a moment, let us leave it like that. And Ramesh was also saying that guidance note is also guiding us in our favor. But the point is, wherever case laws are required to be brought in, and in the tax audit report, if I am not mentioning the tax audit report, chartered accountant is liable for independent different treatment in the disciplinary proceedings. How do you see that in that? Even though it is not directly related to tax audit, I would like Anand sir to mention about this particular issue on this.
See, quoting the case law, we have only one place to quote the case law if you have dependent, that is on the 3CA or 3CB report. And there is a restriction on the number of words that you can add on. So the only other thing that you can do is that when we discussed this in earlier forums and all that, somebody said you better make it a separate note, convert it into a PDF and add it along with the tax audit report, so that at least you can say that you have taken these decisions and based on that only. Though it cannot form part of the tax audit report, it cannot form part of your 3CB or 3CA report within that limitation. So you will have to take that call.
Okay. Next. Sir, next slide. When quantity details could not be made out, Anand sir, for you only. When quantitative details are...
Query was raised by me, so you are putting on to me to give the answer itself.
The problem is we have assimilated all the questions, sir, and we have put it on the classification on the basis of assets and liabilities. If you prefer somebody else could be prefer to answer.
No, I will say what is my opinion.
Others can add on to the value. The point
then
is,
anybody can substantiate. The first part, see, there are areas. For example, I take what you call electrical dealer. He deals in switches of various types, fans, light fittings of different sizes, cables, and so many other electrical items which you take each individual item, it may not have very great value even in total, but the total turnover could be 15 crores, 20 crores. So to give a quantity, how do we go about this one? And see, from the books of account to take out and verify and then say the yield percentage and all that, it is going to be very difficult for the auditor per se. And for the assessee himself, to put somebody else to look into this in clear terms will be going to be a very difficult proposal. It will be costly affair also. So normally what we do is, from the books of accounts maintained, we are not in a position to give this quantity details and get away with that so far. But last 2 years, I find from the scrutiny cases taken by the computer, and we get notices from the faceless assessment range, saying that why you have qualified that and what is the reason. They want the reason to do. We give the same fact. We are yet to hear from what is the conclusion they have arrived at. But this is the problem, that we won't be able to give the exact quantity, and whatever that we give may not exactly match because of so numerous items that are there, and it can. And as part of the second part of the question, the bank value the value given to the bank and the value as per the books. There are given Madras High Court decision itself that if the quantities do tally, and in only the value there is a difference between the value given to the bank and to the books, then the books value can be accepted for taxation purposes. I think it's a Impal limited case that is there, where they gave the market value of the stock to the bank and took the cost value as far as the books is concerned. So they said the quantity, there is no difference. So if the quantity doesn't differ, you have a chance. If the quantity itself differing to the bank and this, then you have a problem on hand, because that means the stock position is not properly given. So you'll have to be very clear what is the stock that is given to the bank, what is the stock. But nowadays I find if you ask for the bank stock, the stock statement is very, very pathetic. It says opening stock, purchases during the month, sales, closing stock. There is no way they have asked for the individual details of what are all the stock that you held. So how much it will be of help to us, because you cannot match the quantity and say the quantity what I have physical and what quantity that is given to the bank is matching. But if you want to do, then you will have to at least keep a quantity details, giving a market value like to the bank stock and cost wise to your thing, and keep it on the book record, so that tomorrow when this question is asked, you are saved.
Leave alone the tax audit, new Caro, once it comes, we might be under compulsion to compare these bank statements and our book statements, etc. That's going to be a difficult problem at a fear. Let us only hope that this keeps on deferred for some more time. Ramnaji, Ramesh, you have anything else on this?
Being a bank matter.
In fact, I just want to supplement what Mr. Anand said about quantitative details. The guidance note says this information should be given only in respect of those items where it is practicable to do so, having regard to the records maintained by the assessee. In a large concern, it may be difficult for tax auditors to verify each and every item of purchase, consumption, and production. In such cases, he may verify the figures on a sampling method. This clause requires that quantity details of principal items of raw material and finished goods should be given. Therefore, information about petty items need not be given. So I think picking up for scrutiny based purely on this may not be right, but then that is what the department is doing, and we need to probably find a practical view of take this. But giving details of all the items is not possible, and the guidance note also says it is not possible. So
whatever happens today in income taxes, many things are not right only, so we don't have an option. And
the second part, difference in stock in the bank, Ramesh sir may kindly enlighten any other views here.
There are also cases where they have gone only by the value as per the statement given to the bank, and not according to the thing. So today, most of our clients are ensuring that the stock value they give to the bank is the same that they declare in the financial statements. But we did have a problem a few years back on this, and it was, of course, the amount, finally the demand amount was not very huge, and therefore we didn't go on an appeal or anything, we paid it off. But it is a problem, especially when the clients do give a stock statement which is different from what is shown in the books. We've also actually advised quite a few of our clients not to give a stock statement as on the 30th of March at all. Give them a stock statement on 28th February, then give them one more on 10th of January, on 10th of February, March, and then give them again another one on 10th of April. Yes, they are going to have some problems with the bank in terms of probably interest for a few days. That will probably be a better idea, a practical idea, rather than going and arguing with the department. I hope this is not recorded.
It is being recorded. Ramnaji, next, but next.
Sir, sorry for interruption, sir.
Yeah.
That query still remains. As tax auditor, suppose there is a difference between the book stock and the bank stock. Now, how and where should I report the difference? That query still is. As tax auditor, when I'm doing tax audit, I found a different stock statement given to the bank, or at least value is different. Forget that the quantity is same, assuming there is a difference between these two per se. Should tax auditor be giving some qualification?
Kishore, if the value, if for the quantity is the same, and if you work toward the value, you do a valuation of the inventory.
No, that is okay, but I'm telling the quantity is different.
The quantity itself is different.
Yes, sir.
Was there a physical verification done? Is there something to state when was the last physical verification done?
I presume that the stock has been given just like that to the banker. Yeah, as you know, to avail the higher credit limits or better representation of financials.
Essentially, I think what you finally need to look at is you are certifying the financial statements as true and fair. I'm assuming that you are the auditor of the company and also the tax auditor. So if you are going to do the, you need to arrive at the closing value, the value of the closing stock by some process. Either by the last physical verification date, and then take the purchases and sales, work out and see what should have been the closing stock. If it has been verified on 31st March, then we need to take that quantity and apply the rate at which it should be valued and arrive at that value. And that is the value that should come in, irrespective of what value is given to the bank. Because otherwise it would not reflect a true and fair view, and you could actually put yourself in serious trouble with the institute. Forget the taxing angle. That is yes, we are concerned about it because finally the SSC comes back to us. But if there is a problem tomorrow, the department reports this, you will have a problem. Your SSC will not have a problem with the disciplinary committee of the Institute of Chartered Accountants, who are today extremely trigger happy and are willing to take, even if there's no prima facie case, they do issue a notice, and therefore we need to be careful about this. We need to go by the standards of auditing and not by just tax audit report or 3CD or 3CA. We need to go by the principles of auditing to satisfy ourselves that the financial statements present a true and fair view of the entity.
Further, Kishorji, in fact, we have to think about that the bankers are also can go on a complaint subsequently. That will be a different issue altogether. So that is salvos are coming from all the directions. From the income.
Precisely, that is the query from me. Yes, there is a difference. So every auditor has to protect himself. How to report the difference?
So no, you don't have to report a difference at all. If you are having a stock figure which is justifiable, valuable, etc., that is a stock which you are going to sign in the P&L account and balance sheet. The same stock we are going to report it here. Where is the question of reporting as far as this bank's stock statement is being there? In the 3CD, I'm asking about 3CD.
Well, to add to what Sundar said, you don't have to report it if you're satisfied about the valuation of the closing stock as per the books of accounts.
Yeah.
Although something else could have been given to the bank. But if this is in the case of a corporate, from next year, we might not be able to take the stand because we don't talk about a lot of other things.
Yes, sir.
Stock statement given to the bank. So we might have to come up with some other solution then. But as of now, whatever be the solution for reporting, I think we need to look at the closing stock valuation, which is the right valuation. And if we are satisfied about that valuation, we need to put that into the financial statements. And you don't have to report the difference between this stock that you are showing in the financials and the stock given to the bank, because there is no clause in the 3CD as on date requiring you to report it.
Okay. G, next and next. You can go to the next.
In fact, maybe what you can do is you can also add in the management representative letter, please take a management representative that they have not given a bank statement as of March or whatever, or it has not been produced to you, so that you are safe.
We are now focusing on another topic on AS and SA. I'm shifting this question to Mr. Ramesh. Whether along with tax audit for SME, any audit report like CARO format is applicable. Please throw some light on the issue that form number 3CD is prepared by the SSC or auditor, although it is to be signed by the auditor. That means it is certified by the auditors. Whether to obtain a signature on the 3CD. All the three are combined together. One question has been put. Ramesh, it's a question on you.
Before I launch into answering these three questions on the screen, let me draw the attention of the participants to a booklet released by the Institute of Chartered Accountants of India a couple of days back, a booklet entitled Approach to Tax Audit. Now, in that booklet, which is mainly a checklist, they have also the Taxation Audit Quality Review Board of ICAI has pointed out certain commonly found errors and non-compliance with tax audit reports. Some which need specific attention of the members have been mentioned. And one of this, what I would like to bring to your attention. It talks about non-compliance with the requirements of standards of auditing, especially SA 700, forming an opinion and reporting on financial statements. Now, SA 700 specifically requires a paragraph on entity's responsibility, management's responsibility, or in this case, assessee's responsibility and the auditor's responsibility. Have these two paragraphs are not present in Form 3CD, 3CA or 3CB. And to that extent, signing them without complying with these two paragraphs will amount to non-compliance with SA 700, because SA 700 applies to everybody, including non-corporates, including proprietary concerns. So paragraph 11.9 of the tax audit guidance note, guide to tax audit, guidance note to tax audit issued by ICA in 2014, talks about how these two paragraphs need to be entered in 3CA. In clause 3CA, where it asks about other observations and qualifications, they want us to include these two paragraphs. Without these two paragraphs, you are not complying with SA 700, and therefore I think this is a must. Please be aware of this. Ensure that this is done in order to not have any problems with the Institute of Chartered Accountants. Maybe if you missed this out, or maybe if you had missed it out earlier, the department is not going to find any fault with you, because I'm sure the income tax officer going through this report does not even know about these two paragraphs. But if there is a problem tomorrow and it is referred to the institute by the department, the first thing the institute is going to ask, you have not complied with SA 700. In order to ensure that we comply with the standards of auditing, please ensure that this is done. Now, the first question is whether along with tax audit for SME, any audit report in CARO format is applicable. To my knowledge, no. But the tax auditor must ensure compliance with revised SA 700. To that extent, since Form 3CA and Form 3CB are required to be filed online in a present form, and same are not in line with the requirement of SA 700, there is no specifically allocated field for providing information relating to the respective responsibility of the assessee and the tax auditor as required in terms of the principles laid out in SA 700. However, having regard to the importance of these respective responsibility paragraphs from the perspective of the readers of the tax audit report, it is suggested that these respective responsibility paragraphs can be provided in the space provided for giving observations, etc., under clause 3 of Form 3CA or clause 3 and clause 5 of Form 3CB, as the case may be. The illustrative assessee's responsibility paragraphs and tax auditor's responsibility paragraphs in respect of Form 3CB have been given in the guidance note. Please ensure that they are suitably reworded to meet the situation envisaged. The booklet also goes on to talk about commonly found errors. Many of the tax audit reports do not have paragraphs relating to assessee's responsibility and tax auditor's responsibility as required by the guidance note in respect of SA 700. Let us remember that this requirement is not by the publication which was released 4 days back, but this requirement is by a tax guidance note and tax audit which has been in existence for almost 7-8 years now. Some of the tax audit reports contained a reference about the attached physically signed tax audit report which mentioned these paragraphs, thereby complying with the requirements of SA 700. However, as for the guidance note and tax audit, the same are specifically required to be mentioned, reported under clause 3 of form number 3CA or clause 5 of form number 3CB, as the case may be. So even though you have a printed one, you have photocopy, you have converted to PDF format and attaching it, it is not sufficient compliance with SA 700. Therefore, you will have to use the choose others from the drop-down menu in the clause 3CA in the utility or in the software and key in the relevant paragraphs on responsibility. Please throw some light on the issue that form number 3CD is to be prepared by assessee or auditor, although it is to be signed by the auditor. That means it is certified to the auditors. Paragraph 914 of the guidance note states the tax auditor should get the statement of particulars as required in the annexure to the audit report authenticated with the assessee before he does the same. Which means I am supposed to get it attested by the assessee even before I attest it. Paragraph 11.1 of the guidance note says the illustrative assessee, that's the one which talks about illustrative assessee responsibility and the auditor's responsibility. The problem is this is 3CD is something that is supposed to be prepared by the assessee, and therefore he needs to authenticate it before I attest it. It is something very similar to a financial statement. A financial statement must be signed by the person who is in charge of the financial statement, and then only the auditor signs. 3CD is the responsibility of the assessee, as very clearly stated in paragraph 11.1 of the guidance note. The assessee is also responsible for the preparation of the statement of particulars required to be furnished under section 44AB of the Income Tax Act, annexed herewith in form number 3CD. Since we have to put this responsibility paragraph in, it very clearly means that the assessee is responsible for it, and we need to only look at it and certify it as true and correct, which means they need to sign it before we sign it. Is that possible? It's a very practical issue here. Previously, when it was manual, we could get the 3CD signed by them and then sign it. But today that is not possible. We need to upload it, and only after that they approve of it. So what do? I, for one, would suggest that we need to take the draft tax audit report, download the draft tax audit report from the software that we are using or generated from the utility of the income tax department, convert it into PDF and mail it to the client with a remark which very clearly states that we have populated the 3CD report, the 3CD form, based on the information provided by you, and ask them to verify the contents of the form 3CD and tell us that they agree with it. It is the particulars given by them, and we can go ahead and file it. Only after that we should file. We probably also need to take a management representation letter specifically for this. Now, I would probably even want the PDF to be digitally signed by them and mailed back to us. But then the problem is the digital signatures of the assays are mostly with us. ICA has allowed us to do that. ICA has given a guidance note saying that you can, I won't say a guidance note, a guidance saying that you can have the digital signature of the assay with you, and you need to get a letter from them stating that this is given for this particular purpose. Even if you have that, I still don't think that you should file a 3CD without them approving 3CD, at least by a mail. If it so happens the digital signature is with them and not with us, then let them sign the PDF digitally and send it back to us, after which we can approve. Now the question, most of the people say, yes, what is wrong if I upload it without getting their concurrence? Because after all, they will approve it afterwards. I don't want to take a risk like that. They might not approve it. We've got to be prepared for all kinds of possibilities, and therefore we need to get it signed by the assessee or confirmed by the assessee that it is these figures in the 3CD have been furnished by them and have only been populated by us, is something which we need to have before we upload the 3CD. The last question, whether to obtain the signature of the client on 3CD, yes, it is a must, which is what we spoke about so far.
Next question. Before going to the next question, in the chat box, we have a comment by Uttamchan Jain. Once the asset is lost, there is no asset in the block, then it is capital loss under section 50, which Anand sir also concurred. But as far as the turnover is concerned, he has raised a point, whether turnover can be borrowed from sales tax law. Purchases more than 1 crore, sales is less than 1 crore. I don't, is it for Ramnath sir? Turnover. He's asking whether the turnover can be borrowed from sales tax law. Purchases is more than 1 crore, sales is less than 1 crore.
There is one direct case law on this. One SSC had purchases more than 1 crore. At that time, it was only 40 lakhs limit. Purchases more than 40 lakh and sales less than 40 lakh. This SSC filed the return belatedly because that was a Ross return. And the department said your sale was less than the turnover and less than 40 lakh. Your due date was earlier. You filed a belated return, therefore your loss was not allowed. But this SSC went to the extent of saying turnover is not defined in the income tax law. I'll give you VAT law. Those days it was GST law, TNGST law, like the state GST law. There he said turnover includes purchases. Therefore, my purchase was more than 40 lakh. That means my due date itself got extended beyond this. Therefore, within the extended due date, I filed return. Consequently, my loss should be allowed. One judgment allowed this. The background behind is they wanted to say the loss has to be extended. Therefore, the assessee fought and got it. So that in extraneous scenario where even the either side turnover number crosses, it could be acceptable. So we have one precedent on a scenario, but it is only an exceptional case, not required to be followed for everything. But if the SSE would like to rely on it, one can, but in the normal parlance, it is not warranted.
Right. The next is regarding Ramesh,
Yeah.
whether tax audit performed under 44AB for cases where income is declared less than the limit under 44AD, ADA, or AE should also be included in the count limit of 60 per CA. This is as restricted by institute. 60 tax audits are permitted for each signature.
In my personal opinion, I would say yes, because both the section 4480 and ADA say if it is not within the, as per the, I mean, they're declaring a profit less than what is stated there, the percentage, then they necessarily have to file a audit report under, carry out an audit in section 44AB and then file the report. So to that extent, I would assume that all these will come under 44AB and therefore will come under the limit of 60 prescribed by the Insurance Charter Accounts of India.
Whether the details of GST...
Sir, Anand sir, would you also agree with it? Or
Yeah, I do agree.
Both of you agree, but the high courts are allowing more than that limits are allowed, sir.
That is not, High Court has not allowed it as that. It's only pending before the High Court. The High Court has not ruled on it. Once they give the ruling, then it might change the matter. But even then, if they say there are no limits or they fix a limit, it will be within that limit.
Within that limit. Whether the details of GST registration cancelled during the year should also be reported under class 4.
I think it should be, because the question says all registrations during the year. So this has been cancelled during the year, and therefore even if the registration is alive for one day in the year, it should be mentioned. And therefore, to that extent, it must be certainly mentioned.
Reporting books of accounts maintained. Do we have to report the books of accounts maintained as per GST Act?
Now let us look at what section 2, subsection 12A of the Income Tax Act says. Books of accounts includes ledgers, day books, cash book, account books, and other books, whether kept in written form or not. So which means it includes day book, cash book, and account books and other books. Paragraph 13.9 of the guidance note on tax audit says, in the case of a person who carries on a business or profession who need not get his accounts audited under any other law, the expression proper books of accounts should mean the books of original entry and other books of accounts required to be maintained to record all the transactions of the assessee in the same manner as in the case of a person whose accounts of the business or profession have been audited under any other law. In other words, what they are saying is the tax auditor should examine whether such books are maintained by the assessee to provide the information and the basis required to prepare the balance sheet and profit and loss account correctly in the formats recommended in appendices 15 and 16 of the guidance note. So essentially, what are the books that you're relying on to prepare the financial statements? I think all those books needs to be mentioned here. Now let us look at GST Act. Section 35 of the GST Act 2017, CGST Act 2017 says, every registered person shall keep and maintain at his principal place of business, as mentioned in the certificate of registration, a true and correct account of the production or manufacture of goods, inward and outward supply of goods or services or both, stock of goods, input tax credit availed, output tax payable and paid, and such other particulars as may be prescribed. Now, I don't see anything here which is not required in the books maintained for the purpose of income tax. Production and manufacture of goods, obviously we need to maintain it for the purpose of income tax. Inward and outward supply of goods or services or both, obviously yes. Stock of goods, right. Input tax credit availed. When I am going to offset the input tax credit against the GST payable, I need to obviously have a ledger account in my books which deals with this, such as the particulars as may be prescribed. Now, what are the other things prescribed? Maybe they're talking about an advance record to maintain all the advances received. And they talk about additional requirements for agents, manufacturers, service provider, works contractor, operator of storage facility, transporter, principal job worker. But finally, all those books that you're maintaining under the GST Act, which has an impact on the financials of the entity, needs to be listed here.
Once again, before going to the next question, Uttam Chand Jain once again gives a valuable input. As per ICA guideline given on 8th August 2008, 44AD, 44A and 44AF audit need not be counted for the limit.
Thanks Uttam for that input.
We will have to update ourselves on that matter and then we can go ahead. You can go to the next question. Ramnath sir, next question. as per section 145A, the taxes has to be included in the purchases, turnover and stock, and accordingly the income computed. Institute has taken a stand that in the exclusive method, there may not be any effect on the taxes would have been limited subsequently before the filing of returns. How do we verify the same from records of the SSC, and what kind of documentation has been kept on record? Ramesh, is it your query?
Queries doesn't seem to agree with the stand taken by the institute, because he says the institute has taken a stand. I personally would feel that whatever the stand the institute has taken and has given us a guidance note, and they've also issued previously on how to deal with send-back credit, I would go by that. In my opinion, as per the ICA guidance note, the impact will be nil. There are several illustrations given in the guidance note, and in my own experience of trying to work out those kind of, from those examples, the impact on certain of my SSCs in the previous years, the impact has been nil, or I would say it has not been marginal. It has not been significant enough for me to report an adjustment to this thing. What we do is we prepare a statement by adding the GST component. Today there is no excise duty, so it's only GST component to the opening and closing stock, purchases and sales, and compute the effect. We draw up an adjustment statement and satisfy ourselves that the impact is nil or not material. In the case of ITC available, we check the subsequent months to see whether the ITC disclosed in the financial statements has been offset against the tax payable, and the entire ITC is wiped out before the due date of furnishing of the return. In such a case, there won't be any adjustment required. In case the ITC as on 31st of March is not adjusted till the date of filing of the return, it may call for an adjustment. The way we verify it, how to verify the same with the records of the C is only the post balance sheet date. As far as the preparation of the statement is concerned, we need to take the purchases, find out the GST component of that and add it to it. Sales, we obviously know for the sales register. And then for the closing stock and opening stock also, we need to add the GST component and compute it. Anybody, sir, Ramnath sir or Anand sir, anything to add to this?
Query is raised by me.
Sir, once again, Anand sir, this is a faceless, like faceless assessment. This is a faceless query raising, sir. So we have not attached any face to the questions. Whatever be the questions.
I'm sorry for the comments, sir.
Because Ramesh does not know. So this is the way it has happened. Next question, which is related to expenses. Ramnaji, provision to 43B states that nothing contained in 43B will apply to sums which are actually paid by the SSC.
I will go ahead, sir. I'll summarize.
Before you were going ahead, Kishorji or Bharatji, what is the timing for which we have blocked it?
No, it can go for another half an hour, not an issue.
No problem. Okay, then go ahead. Okay.
Then, and sir, remaining all, I will put in, instead of reading line by line, I'll put,
okay, you can go ahead, sir. No problem.
Considering the time.
Yeah.
The query, although this slide and the next slide talks about the 43B.
Okay.
And both are dealing with 43B, and the other two slides are dealing with 3615A read with 43B.
Okay, okay.
So if at all this are put together, we can say in the practice we have seen that at the time of issuing report, whatever outstanding on 31st of March settled subsequently, we will give in the tax audit report. But subsequently issuing tax audit report, if the assessee makes some more remittances of those specified items and claims the same in the filing of return of income, CPC, when comparing the amount required to be disallowed, as per audit report, something is there as disallowed, and as per the return of income, it could be even 0 or it could be something less. And as per section 143, subsection 1, clause A, subclause 4, there is an item for disallowance where it says in case in the computation of income in the return of income, you claim something, but your auditor says in the audit report something else, then it will cause for an adjustment. This year, this will be all the more difficult because there is a time gap of 1 month. So from the date of furnishing report to the date of furnishing return, in the interim period of 1 month, ASSI makes some more payment. And the ASSI would like to claim that so that his tax liability ultimately comes down, the issue would crop up further. In those days, when the data are synchronized, but still ASSI furnishes audit report, first auditor furnishes, ASSI furnishes the return late, the gap, the ASSI was faced with the music of having the disallowance, how much ever the replies were given for the show cause notice, resulting in appeal being filed. But this year, the issue is all the more complex because there is a time gap of 1 year. In the Central Council of Direct Tax Committee of Central Council, this issue was discussed. I was a co-opted member, and this was taken up, and the presentation was made to the CBDT to say in the return itself there must be a separate column outstanding on 31st of March, paid before the audit report date, paid before the due date. Up to audit report, the information can come from 3CD. From the audit report date to the date of furnishing return, the information can be punched by assessee. If that is made, then this error would not come, is what we have submitted. And of course, our letters are there, and we will have. Meanwhile, in the current year return, this was not acted upon considering this COVID. Hopefully, this would be acted upon in the next year. This 1 year, this problem will come unless instruction comes to rectify. This is a nuisance value where assessee has no other option except to go under appeal to the SC, because rectification, other option could be to seek rectification number of times, get the matter shifted to the local assessing officer, and then present the case to the local assessing officer, get the 143(1) intimation rectified. This is the only option. Otherwise, legally, as of today, this issue is not addressed electronically. Legally, we have a very strong case. Electronically, this is not addressed. The next query is on related to expense 43B. In case because of COVID, March interest is not debited by bank, what will be the scenario when we are conducting audit? When the arrangement of the bank and assessee itself go to say March interest is not charged by the bank, that means March interest is not found in the bank statement. Assessee is also not accounting it for some reason. Then there is no claim. In that case, nothing to worry. But assessee makes an entry and bank says we will give time. In that case, March interest is not due before 31st of March. Now 43B compels an assessee to claim, to make the payment before the due date of furnishing return if it is found due on 31st of March. If something is falling due after 31st of March and that is not paid before the due date of furnishing return, disallowance is not warranted at all. As per the normal terms and conditions or any other subsequent amended conditions, based on the terms and conditions, the amount should be otherwise due to be paid to the person on 31st of March, and that remains unpaid up to the due date of furnishing return. Only then disallowance under 43B warranted. If as per the understanding of the party or the agreement of the party, if it is not due on 31st of March, disallowance in the current year not warranted. Now next is 40A7, year of making provision, gratuity provision disallowed. Whether there is a possibility to claim it in the subsequent year is a question. Again, electronic way of addressing the problem. Under 43B, opening disallowed, paid during the year we can claim. Under 40A7, opening disallowed, paid during the year, there is no window to claim. Therefore, this question arises, but this could be addressed under section 37 itself. In the year of disallowance, it has not crystallized, therefore we have disallowed. In the year of actual payment or actual payment to the fund, etc., it can be claimed under 37 itself. Therefore, under 37, what is not found in P&L but eligible for reduction as an adjustment item, we can bring in the computation of total income and claim, but need not come under tax audit report.
Mr. Ramnath sir, just
Yes,
one
sir.
second, sir.
Yeah.
You spoke about the bank interest where you said for the month of March, the bank has not debited it. And for whatever reason, the assessee is also not accounted for in the books. Now, if the assessee is following the accrual system of accounting, he has to account for it.
Naturally.
If not accounted, then to that extent, I might have to qualify my audit report.
Naturally, no doubt about it. To that extent, that requires to be. Even if mercantile system, and unfortunately, this is a scenario where 43B indirectly converts an assessee who is following mercantile system to cash system. If an assessee himself follows cash system, 43B does not have implication at all. If the assessee is following mercantile system, indirectly the law pushes him for these items alone to follow cash system. Until 1995, we were doing only that hybrid system. Government said hybrid is not comfortable, therefore they withdraw under 145. Hybrid is taken away, only cash or mercantile. But indirectly, what happens? Items are added to 43B, converting a mercantile system into a hybrid system is what is happening here. To that extent, I am also agreeing, sir. And PF related matters, of course, much questions are in different languages, are given by different queries. Only is the implementation of this 36(1)(5)A proviso against 43B. All of us know very well, originally 43B also had a second proviso to say the employer contribution to provident fund Other labor welfare fund, ESIPF, if not paid within the due date, it will be permanently disallowed. Employees share also disallowed under 3615A proviso. Now 43B second proviso deleted. In 43B parent itself, class B got incorporated, whereas 3615A proviso not altered. Therefore, revenue takes a view that this employee's contribution, if not paid within the due date of the respective section, respective legislature, it has to be disallowed. 3CD form calls for the information, so automatically CPC works on it. Many tribunal judgments are relied on, High Court judgments are relied on. We have Gujarat High Court judgment against the say, Kerala High Court judgment against the say. Recently, Madras High Court, in one of the cases, it is reported that recently Madras High Court has held that employee contribution paid within the due date, if not the same, will not be allowed. Again, we have divergent views. Therefore, CPC per se, going by the divergent views available, does not recognize this as a permissible deduction. It processes the return along with the disallowance. And jurisdictional High Court judgments are available in favor of assessee. Those assees have to file an appeal, because non-jurisdictional High Court judgments are against some way. Gujarat High Court in Gujarat Road Transport Corporation and also Kerala High Court judgment. Therefore, under 154 proceeding, relief cannot be obtained. So the option would be only to go on appeal. And the respective jurisdictional high courts where the reliefs are not provided to assessee has to escalate the matter till the matter goes to Supreme Court. There is no option. But some adventurous assessees goes to the extent of saying, in the due date column itself, we'll put 143.1, 139.1 due date. Let us not give every month due date. So thereby the form will be read as if it is paid within the due date. I personally feel it is a very, very adventurous call. But as we have already concluded, the primary responsibility of furnishing information in the return, in the 3CD, is that of the assessee. If the assessee takes a call that he will furnish only 31st January for all the 12 months of 1920, that due date for that will be only 31st January 2021. He wants us to fill up that and upload. The only option for the assessee, the auditor, would be mentioning this in para 3 of 3CA, para 5 of 3CB. As something as he is of the view like that, assessee relies on case laws to fill this as due date. But how the machine would, in spite of filling up like this, read that as a referent due date, auto-populated, and then work out disallowance, we have to see. But still, the assessee would like to take such an adventurous view. The due date he can furnish, but as an auditor, we need to draw attention in para 3 of 3CA, para 5 of 3CB. And still, if the assessee would like to succeed, it's okay. But I have not experimented anything of that kind, whether the CPC would recognize 139.1 due date as because in the clause it is so mentioned. For clause 16 of 3C, it is so mentioned. But in case system has already got programmed to take up the due date, this information may not match. But still, as an auditor, we should protect our interest by incorporating suitable language in para 3 of 3CA, para 5 of 3CB.
Ramnathji,
Yes, sir.
You were referring to 40A7 in the gratuity. Subsequently, when it is paid at the time of payment, we can also claim under 37. So that sort of provision we will not be able to utilize here.
For 43B or 3615A. No, 3615A categorically says it will not be allowed at all. There it is contingent. 40A7 what seeks to say a provision will not be allowed. There is a difference in language. There, the liability is not crystallized in the eyes of law. Therefore, 40A7 explicitly prohibits to allow in that year. In the year of making provision, it will not be allowed. But here, the law goes to say it will not be allowed at all. So therefore, in that case, it is very, very difficult to take up that view. But of course, what does not come under 36 can one take under 37? One can always experiment.
Yeah, that's exactly, because it's a relevant business expenditure.
Yeah, that always one can take up as an alternative plea.
Alternative argument.
Again, these two slides are dealing only with that, and the last one with reference to expenses, a very interesting question, dealing with two things. The definition of relative, of course, we have an interesting definition in the income tax law. Relative is defined to say an assessee, spouse, brother, sister, lineal ascendant, lineal descendant. This definition is not ipso facto applied to the whole Income Tax Act. We have definition of relative in the Income Tax Act slightly different in some provisions. for the purpose of ETD, in the purpose of education expenses, loan taken on education, payment made. For that, definition of relative is different. And we have section 56(2), definition of relative is different. Section 13(3), definition of relative is different. Of course, one has to now make a coining. In the income tax itself, one may be definition. For one section, he may be relative to me. For other section, he may not be relative to me. That's a problem we are facing. Leave alone all other law where definition of relative will be different. But interestingly, the question before us, the word lineal ascendant, that means on the above side we have to see whether it would be taking all the branches from the mother's side or only from the father's side. Mother will stop, mother's parents or grandparents, great grandparents, whether it will come. On a discussion with a civil lawyer, I was informed that will stop at the mother's side. Mother's parents, etc. In the meaning of ascendant, it would not come, is what one civil lawyer has explained to me. I am unable to lay my hands further on this particular matter. I am after having discussion with him, I've stopped. Supposing other panelists would like to supplement on that, we can do. And the other query with reference to this is with reference to 48(2), related party transaction. The language here is any payment, whether does it include payment made to relatives on a capital field, capital transaction, asset purchase from relative, do we need to report? Now the language employed in 48(2), the payment made for any expenditure, that any payment in between expenditure is there. Any assessee incurs any expenditure in respect of which payment is made or to be made. So first the assessee incurs an expenditure in respect of which payment is made or to be made to a person covered under subsection 2 clause B, and in the opinion of the assessing officer, such payment is excessive or unreasonable having regard to A, B, C, then to the extent of that excessiveness or unreasonableness, he will disallow. That means he should ultimately disallow it. If there is a capital expenditure, to the extent of capital expenditure, even it is found to be excessive or unreasonable, he cannot disallow under 48(2). That means that 48(2) talks about ultimately the expenditure, there must be an expenditure which should be capable of disallowance. In case the AO finds that there is an excessiveness or unreasonableness having regard to fair market of goods, legitimate business needs, and all that we'll have to examine. So if there is a capital expenditure, even if it is found to be excess paid, disallowance under this section cannot come. Disallowance may come under 43 clause 1 explanation 3 or 4 or 3 4 capital A, not under this provision. So therefore, in my personal view, the revenue expenditure in respect of which payment made to related party alone is required to be reported under clause 23.
Sir, with reference to the lineal descendant,
Descendant is
the case reported in AR 2003, Karnail Singh versus Mohinder Kaur. This has something to do with the Succession Act 39 of 1925. There they have said, lineal is that which subsists between persons of whom one is descended in a direct line from the other, as between son, father, grandfather, great-grandfather, and so upward in the direct ascending line or direct descending line. Further, they go on to say, similarly, the descent is lineal if it goes from mother to daughter and granddaughter and great-granddaughter, because here also it is in a right line without any deviation. So this confuses the issue a little more. For that question, he's talking about, can I have the look at that question again? Assessee's mother's parents. Assessee, I think if the assessee is a male, then the descendant will start from the father and not the mother. So that could also be a little confusion. That you gave one definition of lineal as reported to you by a lawyer. We have 2 or 3 cases here which are saying it comes from the father to the son to the grandson, or from the mother to the daughter to the granddaughter. So we need to take a call on that with respect to the, or obtain a legal opinion on this.
Next. This is to Anand sir. Reference to the liability. Whether reporting for specified sums defined in 216 is required for acceptances by an assessee engaged in construction business, property as stock in trade, or is it only for capital assets?
See, the specified sums of if it is stock in trade, once again it is like any other sale, because the 216 ST also talks about transaction where we'll have to report where for beyond 2 lakhs you have, for an event you have received cash. 216 SS also is on the cash transaction. So when property is a stock in trade, definitely it will have, according to me, it will apply.
And
Though he
moreover,
is in the construction business.
there was also an amendment in another section also where it was not, it was only in respect of fixed assets. Subsequently, stock is also included. I think 50 or somewhere also the similar correction was done. Class 31A, whether the opening balance has to be added with the current year loan taken and reported in the column amount of loan or deposit taken or accepted, or opening balance to be considered for maximum balance. For example, in fact, this query is also spoken to me on first half year, that is on 31st of March 2019, the balance was 19,000 rupees. They have received 2,000 rupees on 2nd of April, which means this 20,000 rupees is being crossed in this current year. How will you report it? That is a question.
So since the column does not have for opening balance, you cannot add a column and say it is an opening balance, then addition during the year and all that. So we'll have to only say whatever is the addition during the year you mentioned there, and then say maximum balance. And then if there's any repayment, make the repayment and then show. That is how it has to be shown, because the columns are made up in this fashion.
So which means when there is an outstanding balance in the last year and because of the current year addition, it goes beyond the limit, we are supposed to report. That's all.
Yes, yes.
That is the question. Next is, sir.
Yeah.
Once again to Anand sir on 269 ST.
No, can I just add to what Mr.
Please, sir.
said? Opening credit, the guidance note on the tax audit says opening credit balance of loan taken in earlier years is not specifically required to be disclosed. However, while giving figures of maximum amount outstanding anytime during the year, or while giving information of acceptance and repayment of loan deposit, the opening balance of loan accounts will have to be taken into consideration.
And that's what Anand sir was also
the official version and the
guidance note also is mentioned. So Anand sir's guidance is also exactly like what is a guidance note also.
Right.
Anand sir would have contributed for that guidance note. He is not.
I'm not so fortunate. It's only practically that we took a situation.
Now, many a time it is unfortunate, sir. Yes, sir. You were telling something.
Originally, when the section came in, there was no such classes, columns given and all that. Only talked about saying that whether you have taken any loan. So we used to take the account copy of the respective loan creditors and add it on, so that opening balance, current year, everything will be known. Now this is now restricted this way. You will have to only answer it that way.
As per clause section 216 ST restricts receipts in excess of 2 lakhs. However, class 31 BC and BD requires reporting of payments also exceeding 2 lakhs. Kindly clarify the scope of auditor in this regard.
See, the 216 ST definitely talks about a receipt, but when a payment is made by somebody, unless the information is given, for them to find out what happened to the other person, whether he has returned an income. So I think as a part of that, they have made it a thing. But strictly interpreting, only receipts have to be done as we go by the section. Because any receipt beyond 2 lakhs in cash for a particular transaction or an event, that should be reported. But payment by somebody, that also they want, because as like a SFT transaction, they would like to know whether you have made a payment so that they can catch the other person. So that is how it happens.
Second question is with respect to section 216 ST class 31 BB. When the liability arises with the recipient of the amount, why do we need to report it? This is not the exact question.
Same, what happened to the other one.
While reporting on point number 31D and E about 216 ST, do we need to go even in the earlier year books of accounts to find the mode of transactions?
Yes, definitely, yes. For example, if a person has done it in 2-3 installments and then done, it is for an event that we are talking about is an event. So the events are different. Then, for example, we had a case where somebody bought a furniture for 2.5 lakhs. Earlier year he paid an advance of 30,000. Current year in 3 installments he paid the balance. But total put together it came to 2.5 lakhs. So we reported an SFT. We promptly got a penalty order, and now we are before the appellate authority to say that we have a genuine transaction, party name is there, address is there, PAN number is there, so we should be exempted. But not finding much favor, they are now gone under the Vivad scheme to at least get rid of the penalty, pay by only 50% and get off. That is how the situation arises.
This is almost similar to 40A3 and 40A3A.
Yeah.
Almost similar to this. Next, sir. Next is on this TDS. In case no deduction of tax at source, the auditor has to indicate the same in the report. This makes it automatically call for a disallowance of 30%. The Act also permits disallowance of the same if it is proved that the deductee has included the same in his income and produces a CA certificate for the same. Is there a way to indicate the same in the report, and can we take a stand not to show it as a disallowable item in the report? Anand sir?
Once again, the query is raised by me. So
Then
better ask other panelists.
Ramesh sir would be the ideal
Ramesh sir is willing to answer this. Yes,
No,
go ahead,
question.
Ramesh.
Form 26A, if it has been obtained before the date of audit report, you don't have an issue. You don't have to report this non-deduction at all. Because the guidance note also says where the auditee claims deduction under the second provision of subsection 1A, it is deemed that he has deducted and paid the tax, and hence such sum on which tax is so deemed to be deducted and paid is not inadmissible. The tax auditor should verify compliance with the requirements of section 201. He should also obtain and keep in his record a copy of the certificate in Form 26A as required by section 201, read with section 40A 1A. So if the form is already available, we don't even have to report it in 3CT as non-deduction because it is deemed to have been deducted and paid. But if the form is not available, I don't think we have much of a choice. Just like what Mr. Ramnath was saying in regard to PF, we have to report it. They will disallow. We need to make a representative when they send us the notice. Otherwise, we'll have to go only for rectification.
The last point on this is 34C. Interest on TDS. Should interest be disclosed for the financial year 1920 or interest paid in? They have given the same number, 1920 and 1920.
Yes, sir. Interest paid for financial year 1920
and in financial year 1920. For and in is the difference.
Again, I would go to the guidance note on Insurance Charter of India, para 60.1. It says under this clause, the auditor is required to furnish detailed information in case the assessee is liable to pay interest under section 201(1)A or section 206(c)(7) of the Act. They say the reporting as to whether the assessee is liable to pay such interest should be in consonance with the reporting under clause 34A, which means if I have stated something in 34A as not deducted or deducted but short paid, because of that an interest arises, only that I have to report here, which means only that interest that becomes liable during the year needs to be mentioned here.
Whether net profit is to be reported after considering the income or before giving effect to other income. Ramnath sir, are you taking this issue?
Fine, not a problem, sir. Originally, this has come to other panelists as well. But you want me to have, no problem. But any other person would like to have, also no problem. Whatever way you wanted it to be. You want?
I would assume that net profit is reported after considering all other income, before giving effect to, not before giving effect, considering all other income.
Net profit is to be put all considering other income. See, this question is other income. Now, our guidance note also says before tax we'll have to report, but other income will be counted for rate purpose.
Should the GP ratio mentioned in clause 40 match with GP reported in ITR 6? In case of any discrepancy, will intimation under 143(1) be triggered? GP ratio.
Well, if you say whether it should match, it may not match in quite a few cases. But will the discrepancy trigger intimation? I'm not sure whether the software has been built to do that. It is something which we need to wait and see. We have not, so far we have not had cases where the mismatch intimation being triggered. Maybe looking at, if somebody looks at the YouTube channel and find us, the Income department might even think about this as their software. Till then, we don't have to worry about this.
There are few other issues, and there are also issues which are pending in the earlier occasions. There is a participant's number is getting reduced to 37. We'll go ahead with that. Further questions?
What do you like to say, sir?
Kishore-ji?
Yes, sir.
We'll go proceed now.
Yes, sir. We can have a quick run through, sir.
Then we can go into the turnover issue, Ramnath, with one of the first items which has been pending, which has, I think there is an interesting item as far as ICICI guidance note is there regarding the meaning of turnover and gross receipts, which we kept pending and we skipped it in the initial stages.
We skipped it only for that share transactions, sir. The share transaction, that guidance note is clear. Okay, anyway, if time permits, we'll come back to that. Okay. Would you like me to handle this, or
we can go ahead with the taxability. You can handle it. No problem.
Very
On the death of a doctor. Yeah.
on a death of a doctor, few other doctors gave money to ranging from 5,000 to 20,000 per head to the family of the deceased. Now that amount comes to 10 lakh, is it taxable or not is a question. Now in the old regime, gift tax was there, only the donor would be in trouble, the donee will not be in trouble. Section 10 clause 3 casual receipt, we have on 1974 circular to say, as because casual receipt section 10 clause 3 was there, gifts are not brought over there. Casual receipt is different from gift. Gift comes, gift tax act only will apply, the recipient will not be in trouble, receipt only the donor will be in trouble. Gift tax act got made inapplicable, and therefore correspondingly 10(3) went off, but still things were compatible for a couple of time, and then section 56 to 5 came, 56 to 6 came, 6A came, 7 came, then 7A, 7B, and now 5, 6, 7 got replaced with 56 to 10. Now very clearly to say, unfortunate enough, in these sort of cases, it may not have the character of income per se, but 56 to 10 deems a transaction where there is no consideration chargeable under other source. So therefore, in these sort of pathetic scenarios, naturally, by reading down the interpretation of section 56 to 10 read with 224, one may say this is taxable, but sympathy, we can only call for sympathy from the A1, leave the matter. Otherwise, definitely reading those circulars when the gift tax act was there, this is very difficult to post amendment. And TP related question, it says that where there is a secondary adjustment resulting in advance, treating the excess payment as advance or receivable as advance and receiving money back from the AE along with interest after the cutoff date prescribed, that interest in which year to offer depends on how the TP secondary adjustment starts. If voluntarily it is done, the interest starts from the due date. If done, the TP adjustments for primary adjustment itself takes place in the course of the assessment or APA, etc. Thereafter, after accepting the assessment order, 90 more days is given to bring money. After 90 days, only interest starts. Suppose financial year 18-19, there is a TP adjustment, but that takes back in 20. So after the acceptance of order, 30 days, later on, interest starts. That cannot be for a period of 19-20, it will be only 20-21. But for financial year 18-19, voluntarily assessee accepted a TP adjustment in the time of filing the return itself. Then the interest runs from the due date of furnishing return for the financial year 18-19. That means, for example, October 2019, it would start, or November 2019. In that case, interest starting from that date till the end of that year we should offer, thereafter so on and so forth. But in this case, if the event triggered consequent to the assessment made in a TP assessment, then interest will come only from the financial year 2021. For the earlier year, there will not be an occasion to work on.
Head of income. Anand sir, would you like to take this? Regarding rent received if property is in business, but income is considered as income from house property, what to do?
There's a Madras High Court decision with regard to Chennai housing and all that, where they wanted it to be treated as a business income, because it was IT enabled services building, which has so many other things also as part of the building. So they wanted it to be considered as a business income, and they went up to the Supreme Court, and Supreme Court gave an approval to that. Now we have cases coming in where you have property income plus the maintenance income, and the maintenance includes so many services like a 24/7 backup, lift for all the things, maintenance of toilets, like this. So many conditions are there, and they say they're all part of a business and it should be treated as a business income, not per se a property income. But there are also other cases where earlier where they said property income is specifically given in the act, so property income should be taken as a property income. Others income you will have to take it under other sources where this maintenance expenditures comes in. So you still have to fight. But Madras High Court, as far as concerned, it is strongly held that this kind of a property income, which includes the property rental income as well as the maintenance charges, should be treated only as a business income.
Malls and all are considered as business income, sir. As far as malls are concerned.
Yes, it's considered because it provides so many other services. Not only the space rent, so many things are provided, so they consider it as a business income.
Ramnath Jeda, any difference in opinion or you
fine,
can
it all depends on facts. If malls are providing additional services, it is not rent simpliciter, therefore it should take the character of
business income. if I have sold item lying, this queryist has become the assessee. If I have sold item lying in capital WIP and sold it before being capitalized, then would it be offered to tax as business income or income from other sources?
The capital work in progress is to say that the asset is still not installed and put to use.
Correct.
So you are selling the asset as such once again. So I would feel it is a business income, not other sources. Part of like a sale of asset. So maybe you won't have a capital loss or whatever it is, but I think it will be part of a business income and the cost. So net profit or sale of asset. I will have to say profit on sale of asset or loss on sale of asset.
But whenever asset is being sold, if there is a surplus, we take it to short-term capital gains only, no, sir. Regarding
that is as far as the block concept is concerned. Books wise, it will be only you are not taking it to other sources income. That's what I'm saying. Either it is block of asset or something, it is part of the asset that is being sold and capital gains arrived at. So that is how you should do. There is no other sources coming in according to.
But it is not related to business, no, sir. My business is something else. I started constructing a property. See, for example, if I am in a housing activity, I have a construction property, then it's a different issue. But when I am not having a business of properties, but I construct a house and subsequently sell it off, construct a office or something like that, I sell it off. How do you consider it as a part of the business?
See, though it is not part of my regular business, but still it is part of my business asset. So it should be treated in the way other business assets are treated. So for example, if I rent a property, which is I'm not using it for my own business purposes, the standard is very clear that you should show it as a not part of the fixed assets, out of the fixed assets. So still it is an asset. So I would still consider it cannot in any way come as part of the other sources income.
I think it is not a capital asset because it has not been capitalized. Therefore, it is not a capital asset, but it is an asset of the company. Therefore, it should come to the normal business cycle of the company and not be treated as income from other sources.
Has the income from profit gains and business operation, capital gains, other sources? The deduction from educations may be claimed only with respect to proportionate education cess paid on PGBP. I am not able to understand this question fully. Probably there is a typo error or something like that.
No, the query is because of the latest judgment of the High Court saying your higher secondary, the education chess 3%, 4% is a permissible reduction. Surcharge is only not a permissible reduction, but education chess is a permissible reduction. Is what the latest High Court judgment came up, and therefore all the corporates started now wherever appeals are pending before various levels, they give this as additional ground to get this as a deduction, and wherever assessments are pending, they make alternative claim. Wherever revised return time is available, they are giving. Wherever bigger corporates have paid more amount of tax in the respective years, wherever time available, they are adding this as a ground because the word surcharge is impermissible, whereas chess is considered to be permissible. If that is the view courts have recently allowed because of the recent judgment, everybody started working on. If that is allowed because of the language given in 40 small a clause 2, in that case, whether the allowance can be with reference to the education chess attributable to business profit or the total education chess, which consists of education chess payable on account of income computed under business head, under capital gains, under other sources, all can be claimed against business income. Is the question before us. Of course, here it is a business income on, it is a chess on the tax calculated. It's a permissible business deduction. It can come from any flow of income. So I personally feel the entire amount could qualify, but by the way the corporate started working on this judgment and making claims and case laws, by filing additional grounds of appeal in various levels, High Court, Tribunal, CIT appeal, and making alternative claims in course of assessment, as well as filing revised return in on 1st of February 2021, we will have a retrospective amendment.
That's what we are
planning for. Therefore, very knee-jerk reaction from some segment will invite, definitely government would not leave the money and give the money as refund in all the cases. So therefore, it's only a temporary phenomenon up to February 1st, we'll have an academic discussion. And by and large, I believe definitely government would take note of this judgment and go for a retrospective amendment.
I think this last question we will take it because time is also over. As per ICDS, retention amount is also to be offered as part of the contract income and to be claimed as a base debt in the subsequent year when it is not realized. The records to be perused, it should be perused to arrive at the same. Whether the same can be claimed against any other business if the contract business is closed subsequently.
Ramesh sir would like to handle it. Because I think question has come
On standards, but more of business activity. That is, I think it is on a claim in the subsequent. I think Ramnath sir can handle it.
no problem. See, the first one is ICDS says it is ICDS. No, we all know well it is only advancing the revenue.
Correct. Correct. Recognition.
In the accounting principle, when there is an uncertainty, will defer. But ICDS says you better recognize that as revenue and pay income tax in advance.
Correct.
Having offered us in income and paid tax thereon, subsequently the money doesn't come because of some fault in the performance originally made. The retention money is not payable. The party says, I will not pay your retention money. I have to incur much more expense because of the default or the imperfection in the performance made, and therefore I will retain that money. Now the assessee loses. In the year of losing, he discontinued the contract business. He has got some other business. The loss from a discontinued business, can that be claimed as a deduction in a year in which the business was not there? Some other business income is there. Whether this is permissible? Quite possible. For the purpose of claiming loss from a discontinued business, the loss-making business need not be there, or the original business need not be there. Any other business income, from that business income, this loss can be claimed as a deduction. Nothing wrong in it. That's possible.
Okay. The rest of the questions subsequent to this is on more of charitable trust and religious trust conducting the business activities. There are around 6 questions, I think so, because they're all long. It may not be permitting us time. I think we can take 2 slides on this turnover, which is day-to-day applicable, Mr. Ramnathji. In the first stage, that alone we can touch upon that and we can close for the benefit of the members.
You because tell me which slide.
Meaning of turnover before this. Meaning of turnover before this.
Yeah, I'll go.
Before that, Sundar sir, I have received 2-3 queries on YouTube. I think it will not take more than 1 minute.
Okay, this slide will complete and go.
Yeah, sure.
Or I would suggest that we have one more meeting after some time.
Okay.
Finish the balance queries also on the trust and all that. We can take it.
Okay, we can do it.
Sir, choice is yours. Sundar sir.
Ramnathji, this question we can definitely, because it's a smaller issue which can address in a few minutes.
Fine, sir. This meaning of turnover, gross receipt, etc. Commission agent sale. Commission agent. Now, if the commission agent is going to get commission for the sale of goods owned by somebody, he receives money on behalf of somebody, repatriates the money to the original owner after retaining commission. For him, the turnover will be commission only.
Commission only, correct.
He is acting on behalf of Mr. XYZ, so therefore it will not be counted as his turnover.
This is similar to advertising agents also.
Yes, naturally. For flight ticket agents who are selling flight tickets, all that consigning agents, so on and so forth. Tax audit applicable for a CA receiving remuneration from a firm exceeding 50 lakh, having no other income. Very interesting proposition. Now, if maybe I would be required to take a minute more on this. Now, the section 44AB says every SSC carrying on business, carrying on profession. When a partner, when 2 or 3 people or 2 or more people join together and carry on, whether it is he who is carrying on or he joined as a partner and the firm carries on. When firm carries on, firm has to only undergo the audit exercise, and for him it is only interest and remuneration he is receiving. Therefore, for him, even if the interest and remuneration received is an income coming from chargeable under the head business, then it should not be considered that he is carrying on profession by himself so as to trigger this applicability. This is how we will have to reasonably take a view. Why we are taking this view? Let us take the other extreme. A partner receiving interest and remuneration not from a professional firm, from a business firm he does this. In a business firm he receives. Can he go under 44AD and offer only 8%? Anand Kumar case, Honorable Madras Tribunal categorically said this is not acceptable because partner is not carrying on this business. It is a firm which is carrying on business. For him, whatever he receives, let him produce details as to how much he has expended out of it for the purpose of earning this income. Physically, he has paid money to earn this income. Let him claim. It could be even 93%. Let him offer 7%, no wrong. But flat 80% offering under 44AD, For a partner receiving interest and remuneration from a business firm, 44 AD rejected by Madras Tribunal in Ananda Kumar case. Applying same analogy, we can say when a partner from a professional firm receiving, it should also be not treated as eligible under presumptive taxation if it is 44 ADA. Similarly, for 44 AB, it should not be. But unfortunately, we have one Bombay Tribunal judgment levying penalty of an auditor who had not filed a tax audit report for a case where he received remuneration from a professional firm. Exceeding that day, it was limit of 25 lakh, it has exceeded. Therefore, the levy of penalty by the officer was confirmed. So one end 44 AD rejected. Similarly, 44 ADA cannot be. But the turnover limit crosses, the Tribunal of Bombay categorically says the receiving auditor ought to have audited account. First of all, for this, there is a book, entire amount is offered, one line, one page book and one page audit report. But on a technical note, it was held that levy of penalty was upheld. So therefore, we have to now blow hot and cold to this extent.
Was it appealed against Ramnaji by any chance?
Unfortunately, the tribunal level judgment is only reported. Subsequently, I think we have not got any reported judgment to say how it subsequently went up. So the next one is, so to conclude, less than the threshold, better not to go under presumptive income. More than the threshold, better to get it audited. It's only case majority of nil, not applicable, not available in the tax audit report. Better to get it done so that the consequence could be avoided unnecessarily. Then the share of profit of the firm, whether to be included in the definition of gross receipt for applying tax audit limit. I personally feel this being an exempt transaction, it must not get counted for the purpose of the turnover criteria, the limit of 1 crore or 50 lakh, etc. as the case may be. This should not be counted, is what my personal view, subject to comments from other panelists.
You can, as it is closed, there is no issue.
Kishore sir had
Kishore sir, before that, in the chat room, one question has come. Why do we consider GST for 43B when we never claim it as expenses? This Ramnathji spoke during the process of disclaiming 43B because there was some decision which is happening like that.
Yeah.
Is there any question on your side? Why do we consider GST on 43B when we never claim it as an expenses?
Now, when we are raising an invoice along with GST in the books of account, basic principal value is shown as turnover.
Correct.
The GST collections are shown as collection and payment account.
Liability.
And whenever it is paid, either because of ITC or because of cash payment, it is charged and balance is appearing in the liability side.
Correct.
Now, according to Supreme Court, in the judgment which I have quoted, Calcutta
Aurangi Sales Bureau.
Aurangi Sales Bureau's private limited case, there categorically it is held the collections made towards the indirect tax levy along with the turnover is part of trading receipt. Even though you follow net method of accounting, for the purpose of tax law, we will presume it to be trading receipt. The deductions will be considered as and when paid as if debited to P&L. So 100 rupees collected, 90 rupees paid. If I show 100 as income, 90 as paid, there will be a distortion in P&L. So another 10 rupees I'll add to P&L. So make 100, 100. So it is 0. That balance 10, I'll make a provision entry and show in the liability side. That means effectively I will claim 10 rupees in P&L and appearing in the liability side as payable, which I am not paying before 31st January or the due date of furnishing return. Therefore, 43B comes. So this is how we will have to reconcile the application of 43B on a collection of GST on the sales turnover gross receipt as the case may be.
Kishore ji,
Sir, you have said a couple of small questions.
Yeah, small questions, sir. I'll take it very fastly. A LLP has a turnover of rupees 10 crores. It is liable for audit under LLP Act as well as 44AB. Whether Form 3CA has to be issued or 3CB. Further, in clause 8 of 3CD, which option has to be exercised? 44AB small a or third proviso to 44AB?
Excellent question. If the income tax third proviso to section 44AB categorically says if under any other law audit is conducted, it shall be sufficient compliance of the provisions of 44AB and the audit report and the financials of that law should be given along with an audit report under income tax law and the furnishing of particulars under 3CD. So now for an LLP following the same financial year, 31st March, audit conducted under LLP law, audit report released. Now that is sufficient compliance under income tax law. For that case, 3CA, 3CD will come. Whenever 3CA, 3CD comes, applying same analogy to corporates which are following 31st March, 1st April to 31st March as financial year. The very first year of a corporate, it may not be so, but it can aggregate for 15 months, etc. In that case, that year 3CA, 3CD will not come. 3CB, 3CD will come. Now, in the case also, LLP, where financial year is the common, LLP audit has taken place, we are attaching that 3CA, 3CD will come. In that case, 3CD, class 8 of 3CD, we will have to quote third proviso to 44AB, not 44AB class A. Class A of 44AB says audit under this law. Third proviso to 44AB says audit under any other law. So therefore, we have to quote only third proviso to 44AB.
Sir, in that case, I am taking the question further. Suppose the turnover of LLP is say only 80 lakhs. So under 44AB, I am not supposed to get the books of accounts audited because it is below threshold limit. But under LLP Act, because it is more than 40 lakhs, there is an audit. So should I obtain a form 3CA and 3CD so that I get extended due date benefit?
One second, sir. When LLP Act is asking you to do audit because your turnover it is 80 lakh.
Yes.
It is similar to your limited company having less than 1 crore turnover, you are auditing under company law.
Yeah.
What is that you are going to have? Similar analogy.
Okay.
Why do you go to 3CA, 3CD, all blah, blah?
They want to have extended time, sir. That's all.
Exactly, sir.
But
See,
we are talking about 3CA, but LLP is only a partnership firm.
yes.
So how can 3CA come in?
Yeah,
3CB alone should come.
so now, when a law is requiring to get the accounts audited under any other law, you are getting the accounts audited. But under income tax law, if you are required to get the accounts audited under any other law, then what is the due date? We have to see. So if you are not required to get the accounts audited under any other law, as well as under this law, then obviously you will not get the extended time.
Okay, sir. In case of a partnership firm having turnover of rupees 70 lakhs and has incurred a loss of 2 lakhs, whether tax audit is applicable?
It all depends on what they did in the last year.
Yeah, same
Last
44
year
AD.
they are under 44 AD. This year they are getting out of 44 AD, but income is going to be less than basic limit because 0 is the basic limit, less than basic limit minus 2 lakh. Therefore, even if they walk out, this year audit is not warranted.
Yes. Okay. Trust is running a college. Can it be said that it is doing the business? How do we define business in case of a trust?
Why to get controversy saying college is business? We'll say college itself is amounting to education and go under 12A subsection 1 class B rather than going under 44AB. If the trust has got some other person having some other business giving it to trust, fine. Or the activity of, suppose the same school has got running of hostel or running of canteen, plying of buses, they are considered as business, but under subsection 4A of section 11, they are considered as incidental ancillary to business. They attain the objects of the trust. There again, it will not come under business, and therefore there also get added to the trust income. Therefore, audit is not warranted separately under 44AB. It is better to bring it under the provisions of section 12 capital A subsection 1 class B.
Okay, so the last question is, company carrying on software consultancy business, is it a professional company or a business entity?
Company, once again,
carrying on software development business and software consultancy, is it a professional company or a business entity?
It's a business entity, sir. Obviously, even assuming for a moment very extreme level, we are arguing it to be professional, what benefit you would get?
Suppose the turnover is below, say, the threshold limits of tax audit 1 crore, like 50 lakhs. 44 ADA will apply or 44
ADA for a company?
A company will not apply. Okay.
44 ADA would not come because schema categorically says individual
HFN firm.
Other than LLP. That means obviously that cannot come.
Yeah.
So obviously for a company, any other activity you are doing, it would be regarded as a business only. Now,
that's also only these queries we have.
At extension of due date for an LLP, this section 39(1) explanation categorically says a company or any other person other than company whose accounts are required to be audited under any other law. For him, the audit due date itself is only 31st of January for this year. So if the LLP has got an audit requirement under LLP but not turnover exceeding a crore or reaching a crore, automatically their due date will be only 30th January. We don't need to complicate it by saying we'll go under income tax law extension to get the extended time. For company, any other receiver audit under any other law required, or originally working partner of whom all the partners of a tax audit, all of them will have the due date itself as 30th January. Therefore, under income tax law, we don't need to again bring with 3CA, 3CD. When turnover is less than 1 crore, under LLP law, will do audit issue report without 3CB, 3CD itself, due date for them will be 31st January.
Okay. That's all, sir. Only these queries we have, sir. Yeah, I think.
Sundar, sir. Definitely, it was an amazing session. We have gone for more than 2 hours, 2.5 hours, more than 2.5 hours. We were not able to address few questions which has been raised by one of the audience here, Chaitanya, regarding trust, tax audit coming under trust. As Anand sir suggested, we will go for one more session subsequently on the same topic, because definitely within another 1 month, we'll have some more issues, queries which is being raised. Probably that also will add on, and probably we'll have one more panel discussion. Probably we'll have the luxury of having the same panelist at that point of time with the different questions. Probably we'll have one more session on this matter. Thank you for all the participants who are able to stick on to their computers. Still, we have around how many people? 30 people out of 46.
Sir, apart from that, 30 people are still on YouTube, sir.
YouTube. So another, no, I'm talking about this alone. We had 46 originally. Now it has gone 30. So we have to conclude. Otherwise, probably only 5 of us, probably Natarajan sir is saying hello by showing his face, and Om is there. Om, I think your question has been answered on 43B. Gautam Daga is there. So I have all these people visible on this screen. Thank you very much for your participation, active participation. We would have loved to have more questions, but we had very limited time to discuss. Probably I request all the members who are available here can post for a few more questions subsequently for another meeting. In that meeting, we will have the same panelists and have a discussion probably after a month. I request you all to participate further in sending further questions to the same admin@caconline.org or acachennai@gmail.com. Thank you, speakers, for having spared your valuable time. And special thanks to Mr. Ramnathji, who are able to put extra efforts on putting into the PPT on all these questions. And thanks to Anandji for being a panelist and also throwing some questions. Even though it was a faceless discussion, I did not tell the others that you have raised the question. Thanks for raising the question, and thanks for all those people who have raised this question for us to accumulate and have a discussion. Thank you, Ramesh. Thank you, Ramnath, and thank you, Anand.
We also thank you.
Also sincere thanks to the organizers for giving this opportunity. Every meeting, when we start accepting in the process, it is a learning process to unravel new areas, learn new things. So this meeting is not an exception. This meeting also made me to learn little more than what I was previously. Thanks once again for the opportunity given.
My pleasure. Thank you all.
Thank you, everyone, sir.
Thank you. Thank you.